Okay, so good morning, everyone. Today, inshallah, we'll be reading about reliefs and concessions as stated and described or provided for in the UAE corporate tax law, and probably we will have some references to the OECD's model tax convention as well in this regard, how the international taxation addresses relief and concessions. So the specific agenda of today is we'll be able to identify the reliefs and concessions which help us reduce the amount of tax payable. Will determine how the benefit of claiming a relief or concession, how can we claim it? Then what situations are there in which a relief or tax concession may apply or be overturned as well, like revoked? And we'll learn how to calculate the relief amount in a tax group. There'll be some other things as well, such as qualifying group, etc. We'll read about it. Now, there is an article in UAE Corporate Tax, Article 23, which is on something called a participation exemption. Now, we are going to learn about this. So before we move to participation exemption, this exemption actually addresses dividends or gains on disposal of dividends. But first thing is distinction between gains. Let us read that. Generally speaking, no distinction is made between gains arising from sale of capital assets and those arising from the sale of non-capital or revenue assets. Now, what are these? Capital gains derived from the disposal of assets are included in annual taxable income. In UAE particularly, there is no distinction. The income statement, which is prepared on the basis of IFRS, it can include gains on disposals of non-current assets as well, or even on securities as well. And both are treated in UAE corporate tax law as the same capital gains. It can be on assets, it can be on securities as well. So, but capital gains on the sale of shares may be exempt from corporate income tax, subject to meeting certain conditions. We are going to have a look at how those gains can be exempted. Now, participation exemption regime, basically the word participation uh, refers to equity participation in a company, particularly foreign companies. The background of the participation exemption regime is to prevent double taxation within a group where an underlying group company that pays the dividends or whose shares are being sold has already been taxed on its profits. So, the company in which a UAE taxpayer has already made an investment, they can receive either dividends or other distributive share, and that will be exempt provided certain conditions are met. Now, corporate tax law fully exempts dividends derived from UAE entities. That's a very important concept for us to remember, that if any dividend comes in, if dividend is received or earned from a UAE entity which is established in UAE, or for that matter, which is a tax resident of UAE, that dividend will be exempt, as well as dividends from foreign subsidiaries that qualify as participation. Now we have to read the definition of participation. A participation is a juridical person, first of all, a company. So please remember, there is the expressions used in this article are participation exemption, and in that context, the word that was used is participation. What exactly is participation? It is a juridical person, a company, a legal entity, in which taxable person owns at least 5% of ownership interest. Now, that ownership interest is known as participating interest. So, three terminologies are there: participation exemption, which is exemption granted to a taxpayer when he invests money into a company, which is called a participation. That's the second terminology. And that amount of investment is known as participation interest. But the key point is that this investment, this should be at least for 12 months. That meets the conditions of the participation regime. So 12-month holding period is a key condition. Capital gains, similarly, capital gains on the sale of shares in domestic or foreign entities should also be exempt from corporate tax. So naturally, disposal of shares. This exemption is subject to the same minimum ownership threshold, which is 5%. Just to let you know, just a hint that this 5% was later on further elaborated through a decision. We will probably see the reference to it. So, why? Because some companies are too huge in which we possibly cannot make 5% investment. But for example, Apple, take the example of Apple. It's $1 trillion business, or now Nvidia, etc. And if we were holding shares of such huge entities, their 5% would still be in like perhaps in billions. So it is not possible. It is possible, but it's not practical to say that if you hold 5% of such company share, only then you will get the exemption. That is why later on one decision came. So let us read. Article 23 must be read in conjunction with the ministerial decision number 116 on participation exemption. Uh, this decision probably will be elaborated later. It slightly modified the 5% criteria. So first of all, participating interest. Income from a participating interest is exempt from corporate tax if the interest meets the Article 23 condition. Now, what are those? First thing, participating interest is a 5% or greater ownership interest in the shares or capital of a juridical person, legal person, referred to as participation, where all the following conditions are met. To be able to access this concession, this exemption, the participating exemption itself, which is exemption on dividends and capital gains subject to other conditions being satisfied. The UAE taxable person must hold shares or capital with situations such as the US LLCs which issue member interests rather than capital, and the holding must be 5%. So, in certain US corporations, the word capital may not be used. So that is why the ownership interest, in easier words, ownership interest is the criteria. Ownership of the capital of a juridical person is not defined. However, internationally, capital of a juridical person is not limited to amounts of money paid upon shares, because it can extend to debt capital in circumstances in which debt capital is booked as shareholder funds under IFRS. Yeah, this is something that you might see in any part of the world, including UAE, where under IFRS, even a loan that was given by shareholders may meet the criteria of equity. So apparently it's a loan, but that meets the criteria or conditions of equity, and it will be presented on the financial statements as equity. So a participating interest, Abu Dhabi ADGM Commercial Licenses Regulation 2015. So now this is a reference to commercial law of 2015 in ADGM, is defined to mean an interest held by an undertaking in the shares of another undertaking, which it holds on long-term basis for the purpose of securing a contribution to its activities by the exercise of control or influence arising from or related to that interest. In short, the criteria of control or influence has been mentioned here. So they have gone beyond the word control. They've included influence as well, because as a matter of fact, like if you really think about it, 5% can never mean control. It most likely will mean influence. The reference to an interest in shares includes an interest which is convertible into an interest in shares, such as a convertible note of additional tier 1 capital. So there may be a loan which is convertible. So that could also be seen as as a participation interest. An option to acquire shares. So share options could also be seen as participating interest. And interest or option falls within the paragraph A or B, the previous two categories, notwithstanding the shares to which it relates are until the conversion unissued. So, this area alludes towards conversion of loan or debt capital into shares. So that can let us have a look at further examples. The further provisions actually. The taxable person has held or has the interest to hold the participation interest for an uninterrupted period of at least 12 months. So anybody talks about a foreign investment, the first criteria is we'll talk about the type of ownership interest later, but first of all, is it a 12-month holding period or not? If it is interrupted period, then the participation exemption goes out of question. The first test to access the concession is that the taxable person must have held the shares or capital for a continuous 12 months period. That's the first condition. The decree law does not define to hold, but shares would not likely qualify for the relief if while the taxable person held the shares that the person was not the real owner of the shares, such as would occur if the shareholder was a nominee shareholder. So that's a concept where the ultimate beneficial owner, UBO, comes in. If a person was holding shares on behalf of another person and it was clear a UBO declaration was available for that purpose, then just a nominee shareholder or an agent shareholder would not be considered in this regard. So it will be the ultimate beneficial owner shareholder that will be considered. Potentially, the corporate tax advantage rule would prevent the holder from qualifying for the participation, except in the circumstances in which the main reason for the holder holding the shares during that period was commercial. So in short, the economic reality of such holding should be for the purposes of benefit of the ultimate beneficial owner. It should be noted that the intention to hold precondition has been adopted from the Luxembourg participation exemption. So this is an international law or framework in which this matter has been addressed. The intention to hold precondition has been adopted. Intention to hold. So, 12-month period has not completed. We're still in the 10th month, but the declaration is provided by the UBO shareholder that we intend to hold it for the next 12 months. That will also suffice. The participation is subject to corporate tax or any other tax imposed under the applicable legislation of the country or territory in which the juridical person is resident, which is of a similar character to corporate tax at a rate not less than rate specified in Article 31B, 31B of the decree law. So please note that there is an Article 3 in the corporate tax decree, if you remember, which identifies the different regimes. So in that in the decree law, the Article 31A is normal tax regime and Article 31B is, if I remember correctly, Article 31B is for qualifying. Let us have a look at the decree law because that's a question mark actually. Let me open the UAE corporate tax law. So if we look at Article 3, that's what this is Article 3. So Article 3, Clause 1B identifies 9% tax rate. 31A, 0% up until the point of threshold of 375,000 dirhams. And above that, 9% tax rate applies. So, this is clause 1 of Article 3. And A and B are the paragraphs. Clause 2 is for the qualifying regime. So if we really look at it, basically what is being said is that the foreign jurisdiction where the company resides should at least have a 9% corporate tax rate. If the rate is below 9%, then it will mean that the participation exemption will not be available to those in the respect of those shares where this foreign company is established. One example could be the tax havens, which is, for example, Cayman Islands or British Virgin Islands, where tax is not there, or very low value of taxes there. So those holdings will not attract participation exemption, and they will be taxed actually. If you receive any dividends from Cayman Island or British Virgin Islands, even if you meet the 5% criteria, the participation exemption will not be available. A precondition for the exemption in the circumstances in which the company was formed outside the UAE is that the company is subject to corporate tax. In the tax imposed under the law applicable in that territory or country at a rate not less than the rate applicable to the UAE to UAE taxable profits. Internationally accepted meaning of a company being subject to tax is not disturbed by the deriving income such as dividend or capital gains, which are not liable to tax in the country due to that country exempting dividends or capital gains under its own participation exemption. So what is being said is that in the country from where the dividends are coming, even if that country exempts, that does not disturb the provision. An example, let us read the example. An example would be if a UAE taxable LLC person owns 100% of the stock in a BVI company, the $2.5 million profit arising from the disposal of the stock in the BVI company would not qualify for the participant exemption because BVI company is not subject to 9% tax rate. So that's the summary of it, is that the country from where this dividend is coming or capital gain is coming, there should be corporate tax there, and it should be at least 9%. The ownership interest in the participation entitles the taxable person to receive not less than 5% of the profits available for distribution by the participation and not less than 5% of the liquidation proceeds in case of liquidation or of participation. So these are usually referred as distributive shares. So it's a broad terminology, distributive shares. It can be profit distribution, it can be liquidation distribution as well. Qualifying as a participation is dependent upon the percentage profits, distribution, and gains to which the shareholder is entitled rather than the percentage voting interest. So it's the distributive share that defines determines whether this is a participation, whether the participation exemption is available or not. So it's not only voting rights or holding of the share capital only. So not more than 50% of the direct and indirect assets. Now, this may sound a little complicated or complex, but I will try to make it easier to understand because this is probably the most difficult language used in the corporate tax decree law in Article 23. But let us go through it. Let us try it. Or maybe they have given an example. So anyways, we'll look at the example at the end, even if the wording may not be very clear. Not more than 50% of the direct and indirect assets of the participation consist of ownership interests or entitlements that would not have qualified for an exemption from corporate tax under this article. Let us directly read the example to easily understand. An example would be when a UAE taxable juridical LLC person owns 100% of a UK limited company. And if the UK company owns service contracts, which represents 60% of the UK limited company's value, then the £1 million gain arising to the UAE taxable persons on sale of stock in that UK company would not qualify for UAE participation exemption. Why? Because the gains attributed to those service contracts would not be exempt under participation exemption were the UAE taxable person to have owned them directly. So, so it's a, how do you say? It's a boomerang arrangement. So it's a tripartite arrangement. So think of the UK company as something which has been artificially planted there. so that we may claim that no, this dividend is coming from UK. That is the reason, and we hold 100% interest in the UK company. So we meet the criteria of 5% minimum shareholding and distributive share. So this amount of money or dividends that we are receiving from UK should be exempt. But the interesting point is that the UK company was actually holding service contracts in UAE. 60% of the UK limited company, if the UK companies own service contracts, which represent 60% of the UK limited company value, then the 1 million gains arising to the UAE taxable person on sale of stock would not qualify. So if the UAE company was holding these service contracts directly, then it would be taxed. So it's a kind of a way to avoid tax. That is why this exemption would not be allowed. This participation exemption would not be available. I hope this point was clear. Any questions on this? I'd like to, I'd allow you to ask any question in this. No? Okay, I will move forward. So how many people are there? 8 people have already joined. Okay, good. Another condition as may be prescribed by the Ministry of Finance. So that's any other condition. So for that, I think we can look at the decision that was there. So a participation shall be treated as having met the condition under the Article 23, where the foreign company meets the subject to tax requirement, where all of the following conditions are met. Let us have a look at it. Principal, objective, and activity. The principle, the ordinary law meaning of this is the first in the order of magnitude. The objective and activity of the participation is the acquisition and holding of shares or equitable interest that meet the conditions of Article 23. So what we are talking about is that the principal objective and activity of the participation is the acquisition and holding of shares or equitable interest. So it should hold shares and equitable interest that meet the conditions of Article 23. In summary, holdings principal objective and activity must be such that all the Article 23 requirements, such as the 12-month holding period, etc., are satisfied. Income. The income of participation derived during the relevant tax period or tax periods substantially consists of income from participating interest. So basically, the participation entity in the foreign country should hold equities and interests, etc. And the distributive share comes to the UAE taxpayer company. In determining whether the foreign company's income substantially consists of income from participating interest, it is necessary to determine the meaning of substantially and secondly of income from participating interest. So these two words, with neither term defined in the decree law, it is necessary to look at the ordinary meaning of the words for tax purposes. For this purpose, substantially usually means significant or large, and in the United Kingdom, substantial in the substantial shareholder exemption mean at least a 10% holding, while in Canada, a holding has been deemed to be substantial when it exceeds 5%. While in US, a substantial underpayment of tax arises when the tax was underpaid by 10%. So basically between 5 to 10%. That would mean substantial. The meaning of income from participating interest would normally consist of dividends and capital gains. If debt capital is booked as IFRS, as equity capital under IFRS, then interest on the debt capital should be income from participating interests. But without clarification from the Ministry of Finance or the FTA, their intention is unclear. So that's a gray area still. I have seen, as I mentioned earlier, in case of a listed entity in UAE, I saw the financial statements, which were signed by a top tier audit firm of the world. The loan from shareholders was booked in the balance sheet as equity interest. So it was not identified as a debt capital, but equity interest. So if there is any payment of interest on such a loan, it will not be seen as interest. It will be seen as basically an equity distribution. Principal, objective, and activity. So we have an example. If the stock in a BVI company is owned by a UAE taxable LLC, and that BVI company has incurred $7.5 million in purchasing stock in a New York Stock Exchange, so listed company, and $2.5 million incurred in purchasing a restaurant in Road Town, Tortola, the Article 23 requirement would be satisfied. So basically what is happening is UAE company holds shares in BVI, and that BVI company is investing in other countries out of UAE, basically. So this would be satisfied. So that circumvention or avoidance of tax is not present here. For example, if that BVI company was again investing back into UAE, that would have been a measure to avoid tax, if you really think about it. Because this is just creating a mechanism whereby you can present in front of the federal tax authority that hey, we received dividend from a foreign company. But if you really think about it, that foreign company was investing back into UAE. So and that money would have been taxed in UAE. Another example, income. UAE taxable LLC person invested $20 million in a Netherlands established company. Now, again, you might have heard Netherlands is also considered as a lower tax jurisdiction. But anyways, in 2021, which in turn owns stock in trading companies in France, 15% stock, Germany 10% stock, Sweden 17.5% stock. Netherlands company has held stock in the French and German company for 2 years, and the Swedish company for 6 months only, but intends to hold the Swedish company stock for at least 5 years. So if you remember, intention to hold stock also counts, right? In 2024, the Netherlands company receives $1.5 million worth of dividend from the companies which are participation exemption in the Netherlands. The Netherlands company pays $1 million worth of dividend to the UAE taxable LLC in 2025. This dividend should be qualified for UAE participation exemption because the Netherlands company's income is substantially from participations. That's a very good, beautiful example. The idea was that the foreign company should be holding interest in other companies. So, and then later on distribute shares to the UAE resident company. Now, let us have a look at participation in a qualifying free zone person. Now, why is this even highlighted? So if you recall, the whole point of a qualifying free zone person is that they are earning majority of income. Their majority of income is qualifying income. Only then it will become a qualifying free zone person. And what happens when a company becomes a qualifying free zone person? It pays zero tax on its qualifying income. So that's the whole point. Now that qualifying free zone person anyways is not paying any tax. So let us have a look at what will happen. A participation in a qualifying free zone person or in an exempt person shall be treated as having met the condition under the Article 23 2B, subject to any conditions that may be prescribed by the Ministry of Finance. At the time of writing, no such conditions have been published. So one participation company invests in a qualifying free zone person. But let me ask you this, if anyone can answer that. What is this scenario actually? Can somebody give a scenario on this? How can a participation invest in a qualifying free zone person? Can somebody tell me about it? So, like I can see that Haya is there, Kalama is also there. I don't, yeah, Abbas is also there. So, guys, give me an example, just a fictitious scenario where a participation can invest in a qualifying free zone person. Kalama, are you there?
Actually, I joined in between the lecture, so I missed the participation.
Okay, how many
What
people
was it?
did? Like, how many people know what is meant by a participation? Look, I will repeat it. Please understand that participation is a legal person. Okay, participation is a legal person, which is not in UAE, which is outside UAE. So I'm repeating this point. What we are studying today is Article 23. Okay, uh, since you guys have joined late, so I'm going to repeat this quickly because this is a very important point and it will come into questions or real life scenarios. This will be there. Let me just write Article 23. There you go. Look, Haya, this is what we are studying, Article 23, which is on participation exemption. Okay. Uh, Please understand that participation has been actually defined as well uh, in the definitions, but it is a company uh, in which a UAE company, a UAE taxpayer invests. Okay, participation is a foreign company in which UAE taxpayer invests. Participating interest means if 5% or more shareholding in that foreign person by a UAE person. Is this clear?
Yes, clear.
Now, what is participation? It's a foreign company, correct? It's a foreign company. It's not a local company. So my question was, can there be a scenario where a participation in interest in invest in a qualifying free zone person? A participation in a qualifying free zone person or in an exempt person shall be treated as having met the condition under Article 23, subject to any condition. What was this article about? If a UAE taxpayer holds 5% or more equity or right to receive profits or right to receive liquidation proceeds, then that dividend that comes to that UAE company or that liquidation proceed or capital gain that comes to this UAE company will be exempt. That is the intention of this article. Okay. So let me give you
Okay.
yeah, yes, who is this? Yeah.
I said I got it. I said I got it.
Okay, perfect. So one foreign company may invest in a UAE qualifying free zone person. Okay, and since UAE qualifying free zone person does not is not paying any tax as such, and what the intention of this provision is that it will still qualify for this participation exemption. Since neither a qualifying free zone company nor an exempt company is taxed at the rate of 9%, but for Article 23, Clause 4, the person holding a qualifying participation is either of those companies may fail to satisfy the subject to tax clause. Some may believe it necessary for this clause to be extended to a free zone company because that company's income is subject to tax, but simply not taxed. See, qualifying free zone person's income is subject to tax at the rate of 0%, but free zone companies, not necessarily. So, let me ask you a simpler question. Uh, is there a difference between a qualifying free zone person and a free zone person?
Yes.
What is that difference?
Uh, Free zone if, for example, if there is a free zone company and their income is not qualifying, then it can be termed as a free zone and they will be taxed at 9% instead of 0%, which is for the qualifying free zone.
So can we say that qualifying free zone person is a subset of the larger expression called free zone person?
Yes.
Correct. Yes. So all qualifying free zone persons are free zone persons, but not all free zone persons are qualifying free zone persons. Okay. So let us have a look at the exemption, where the conditions of this article 23 continue to be met. There are various types of income found in the timeline below that shall not be taken into account in determining the taxable income, meaning those incomes will be considered as exempt. So this is a practical point that I am raising here. You guys are doing an impact assessment of a company, UAE company, okay? And you come across the profit and loss account or uh, income statement of that company. And interestingly, most of the times you find uh, dividend income, for example, but that dividend income uh, you see as being received from a foreign company. Okay. So what will you do? You will, first of all, you would need to go into the notes to the financial statement, and you would have to look at the breakup of that dividend income. In that dividend income, you will find that some of the dividend was received from foreign companies, right? So what will you look at when you look at those dividends that were received from foreign companies? You are going to look at a possibility of considering those dividends as exempt income. But so Mujaddid, let me ask you this. That dividend income that you are evaluating for participation exemption, what are the things that you are going to look at? What are the things that you're going to evaluate?
Uh, well, any dividend received from local companies, it will be the exempt. And for the foreign dividend breakup of foreign companies, we will try to see the participation exemptions conditions. Like, let's say, like it holds 5% or more, and then it is held for 12 months, and then it should be taxed at least 9% or more
Okay. How
to
about
claim the exemption.
Okay. So that 5% condition was later on changed. Do you remember how was it changed? Like, for example, if a UAE company is holding shares in Apple, which is a $1 trillion, $3 trillion market cap, right? So you can imagine how much the 5% of that $3 trillion would be, right? That dividend received from Apple, would that be immediately excluded from consideration for exemption?
Well, I never looked at the changed condition, but there may be the cap of the dividend received amount.
Yeah, so that 5% was later on modified to $4 million. So they said if the UAE company, because Ministry of Finance realized that for huge companies, global companies, the 5% condition is not practical, right? Nvidia or Amazon or Apple or Google, they are like extremely huge companies. 5% condition will never be met for them, right? So what they did was they said, okay, let us fix a set amount. So they said, okay, if you are holding 4 million dirhams worth of investment in such companies, then it will be construed as if that hold 5% minimum holding criteria has been met, even if it is not 5%. Is this point clear to everyone?
Clear.
So when we look at the income statement, what we will look at is that this dividend that is coming from the foreign company, you rightly mentioned, Mujaddid. We are some basic level of things that we are going to look at is, like, first of all, is it actually equity related? Is like this whether this was an actually a dividend, or maybe a if not dividend, was it capital gains on disposal of the shares, right? Or was it like liquidation proceeds that came in, and was it were these shares held for an uninterrupted 12-month period or not? And then was it we will make sure that this was not an attempt to circumvent taxable profits, like though that company which from where the money came, the dividends came or something. It was not investing in UAE companies again, where uh, if the UAE company was directly holding a service contracts or other trade related contracts with income of which would have been included. So, this circumvention must not be there. These are the basic criteria that we are going to look at. And let's say, okay, next question. Let's say we conclude that, yeah, apparently it meets all the conditions of participation exemption, right? Now, this is an easier question for everyone. Once we conclude that, okay, these dividends and distributions meet the conditions of participation exemption, then what will be the impact on the corporate tax return? Can somebody give this answer, please?
We will not considered as a taxable liability in the calculation of taxable liability for this
Taxable income.
dividend.
Yeah. We will not include it in the calculation of taxable income. And in order to do that, in the corporate tax return, we have an adjustments column, right? Where we exclude the exempt income. So that adjustment will fall there. So it will reduce our taxable profits. Okay. So the participation exemption applies to dividend and profit distributions received on a participation held by a UAE taxable person in non-resident persons. Ministry of Finance or the FTA should define a profit distribution, because without such a definition, a profit distribution would be confined to a sharing of the profits of a company amongst the shareholders of shares in that company. So gains and losses on transfer, sale, or other disposition of a participating interest. Now, this word participating interest refers to shareholding. Easy words, shareholding, holding of ownership, derived after expiry of the time period specified in Article 23 or 2 or 23(9). This clause provides for a profit or loss on the restructure of a company of the company of a participating interest, not to be liable to corporate tax, provided that the participating interest had been held for not less than a continuous 12-month period, or for a continuous 24-month period in a previously implemented corporate structure. The 12-month condition is very much there. Uh, and another thing is, or for a continuous 24-month period in a previously implemented corporate structure. So if it were a case of restructuring, then the holding period changes to 24 months. Foreign exchange gains and losses. Foreign exchange gains or losses in relation to a participating interest. Since for the corporate tax purposes, assets and liabilities are required to be recorded in the books in AED currency, it is unlikely that a currency gain or loss on participation could give rise to a foreign exchange gain or loss. Yeah, so this is a condition. It's a decision as well, in which it is clearly, actually in decree law itself, it is mentioned that the currency used to report transactions and balances, it will be AED. So chances of foreign exchange gain loss rising may not be there. Were the currency exchange gain or loss to arise on the repayment of a foreign currency loan drawn down to finance the participation, then that gain or loss would adopt the same character as that of the stock holding which it financed. So it will be included in the overall transaction of distributive share. So even so, under IFRS, naturally, because IFRS can allow a reporting currency other than AED itself as well. So there may be, some foreign exchange gain or loss that we may find in our financial statements, but uh, that gain or loss would then be included in the value of distributive share, the amount that we are considering for exemption or otherwise. Let us have a look at the example. An example of this would be if a UAE taxable company purchases a stock in a French company in March 2023 by paying 5 million euros. The UAE person swapped approximately AED 19.5 million, so in which it borrowed to acquire the 5 million euro in order to conduct the transaction. An exchange rate of approximately 3.91. Assuming the stock is sold in April 2026 for 6 million euros, which at the time translates to AED 21 million due to the exchange rate, then exchange rate then being approximately 3.5, the gain on repayment of the currency would also be participation exemption. The gain or loss will gain the same characteristic as the amount which we are considering for participation exemption. Impairment gain or loss. Impairment gain or loss in relation to participating interest. Amounts written off from the cost incurred for accounting or the full or partial reversal of those written off amounts brought to revenue for accounting will neither be tax deductible nor included in the taxable income if the stock, wherever the word stock comes, we are talking about securities. If the stock or interest holding qualifies as participation interest under the participation exemption rules. So why is it so like what happens when we impair an investment? What do we do? Normally we would charge it off to profit and loss account, right? But if an investment was that kind which was meeting the conditions of participation exemption, so any income that comes from that investment would be exempt, right? So if we are for such an asset whose income is exempt, if there was an impairment loss that was booked in IFRS compliant financial statements, don't you think that loss should also be excluded in our corporate tax return because it relates to an asset giving rise to an exempt income? What do you think, Abbas?
Yeah, it should be exempted. I mean, not made part of the
Uh,
tax calculation.
what will be the consequence if while doing a corporate tax impact assessment, we left that impairment loss in the taxable profits? Will it overstate the taxable profits or understate it?
It would
Overstate.
overstate the
Overstate.
taxable profits.
I think you guys want to say understate. If we leave that taxable, if we leave that loss in the taxable profit, it will understate our profit. We have to adjust it and increase
Hmm.
our taxable profit with that amount, impairment loss,
Yeah, yeah,
right?
yeah.
Why are we, let us ask ourselves this question. The topic that we are studying right now, this topic is of participation exemption, right? Which industry is it most likely to come in? What type of companies we might, face this provision, Article 23? Which companies we might find these things mostly?
Holding
Large companies,
companies,
MNOs, listed companies.
Is it? What about you, Abbas? You want to
ba-
say something?
maybe holding companies, banks. They might have a lot of investments. Investment managers.
Yes,
These
that's
sort
what I
of
was
companies.
talking about. So those companies which sometimes which may have an extensive amount of investments reflected in their balance sheets, right? Or whose core business involves a lot of investments. Investment companies themselves, banks, rightly said by Abbas. What about insurance companies?
Yeah, insurance company as well.
Insurance companies as well. So these companies, probably we will see this type of a possibility of participation exemption quite a lot, especially from banks' perspective, because a huge amount of the treasury fund, etc., are used for investments into shares and stocks and whatnot for sometimes even placements as well. So we should be careful about this matter, and especially for listed entities. Yes, the quite a lot of treasury operations are there, and they invest excess funds into foreign companies or other mutual funds, etc. That's where we must be very careful. Exemption withdrawn. The exemption under Article 23 shall not apply to income derived by the taxable person from a participating interest. So this is basically withdrawing of exemption. Insofar as the participation can claim a deduction for the dividend or other distributions made to the taxable person under the applicable tax legislation. Why is this sentence coming in? Can somebody explain this? If a participation, that foreign company, can claim a deduction for the whatever amount they have sent to the UAE person, UAE taxable person, then this participation exemption will not be available to this UAE person. Why is it that they are saying that? Can somebody explain this to me?
Maybe they charge this income in their as a deductible amount in their tax return.
Who? When you
The foreign
say
company, the foreign
foreign,
company.
so foreign company is sending us money. Let's make it simpler. They are sending us money. A UAE company, they're sending a UAE company some money. So it cannot be an income for them. It will, if at all, it will be an expense for them, right? But is it actually an expense that they're sending?
Not as per UAE law.
Yeah, so that's the whole point.
Hmm.
If the money that this foreign company is sending us, a UAE taxable person, if they're booking that amount of money in their profit and loss account as an expense, when do we ever book dividend paid as an expense? Can somebody tell me? You guys are professional accountants. Can you book dividend paid
No,
as an expense?
no.
You cannot. What is it? When we pay dividend, is it an expense or a movement on equity?
Movement of
It's an
equity. We
Movement
equity
just
on
receive the
distribution.
profits.
Exactly. So the revenue authorities around the world are they are very clever, and they look at it. That company which is sending us dividend in their own profit and loss accounts, are they booking it as an expense, or are they booking it in their financial statements as a movement on equity? If they book it as movement on equity, the revenue authority of UAE or UAE is okay. The FTA will be fine. Okay, fine. The other company is not claiming a deduction in their P&L. So this is actually a dividend. From their perspective itself, it is a dividend. But if they were booking it as an expense, then the UAE authority, the FTA, will not accept it. Ministry of Finance will not accept it as participation exemption, participation, distributive share. They will exclude it. That was the first point. Second, the taxable person has recognized a deductible impairment loss in respect of the participating interest prior to the participating interest meeting the conditions of Article 23. So what happened was that, okay, I will not explain. Let me ask the participants. How can you explain this second point? Can somebody explain this? Let me read it again clearly. Taxable person has recognized a deductible impairment loss in respect of that participating interest, that investment that was reflecting in the balance sheet. Okay. prior to participating interest meeting the conditions of the exemption. What happens when we
When
just discussed it about impairment?
when all the conditions are met, then we can then this is the exemptions apply actually. So before meeting all the conditions, we cannot claim any loss or gain as an exempt loss or gain.
As an exempt loss or gain. But what if,
Yes.
see, okay, let me give you an example. The you are a UAE company here, okay, Haya Husban LLC, okay. You had an investment reflected in your balance sheet, okay, at the beginning of 2024. That investment was in a US company, let's say, okay, US company called Mujaddid LLC or Mujaddid Corporation. Okay. So you at the beginning of the year, your investment in Mujaddid Corporation USA was not meeting the participation exemption criteria. Okay. But you had intention to hold or whatever. And some genius guy advised you, Haya, that the US company Mujaddid LC is in dire troubles, so maybe it is a wise idea for you to book an impairment loss. Okay. So what you did was you booked an impairment loss for that company already. But by the end of 2024, you realized that, hey, we are meeting all the criteria for the participation exemption because we've already held for 12 months. We have at least 5% or 4 million dirhams worth of investment in Mujaddid Corporation USA. All other it is not an arrangement to circumvent UAE corporate tax, etc., etc. Uh, so will you be eligible to claim participation exemption if you receive dividends from Mujaddid Corporation USA now?
Yes.
Anybody else concurs with
N-
Haya?
n- No, you cannot, because it's saying that for losses booked before it became participating interest, in that case you cannot get the exemption.
Exactly, Haya. Abbas is right. The mistake that Haya Husban LLC did was that it booked impairment loss at the beginning of 2024. If you had not booked impairment loss for this investment, because you deducted it from your taxable income. So the only way that you may be able to do that is if you reverse it or remove it from your books. So that's a condition you guys should remember.
Sorry, just one thing on this question. So, on this point rather. So, okay, but why? But I think we read previously just now that um, if there's any loss or booked on a company that is a participating interest, so you cannot claim that loss as part of your tax return, right? So in this case, okay, even if let's, um, why is this company being penalized? Because if let's say the loss was booked before, like for example, the company had 3% interest, and at that time the loss was booked. However, later on they acquired more shares, and now they've become 5%, and the holding got 12 months and all of those things. So why is the company being penalized for its actions done in the past?
Hmm. So in your scenario, you mentioned that previously Haya Husban LLC had actually invested only 3% at the
Yeah,
beginning of 2024, right?
yeah,
So
yeah.
at that time, it was not meeting the conditions of being a
No,
participating interest, right? Later
yeah,
on, they made an additional investment of 2%, right? So
yes.
just think of it, Abbas, in my view, we may think of it as we may form an analogy of it as the pre-tax losses. So why don't we set off those pre-tax losses with us? Why? Because the company or the taxpayer was not subject to tax previously, right? So that is why those losses were
Hmm.
disallowed. Same thing applies here. So if this participation, this investment in the books of Haya was not meeting the conditions at that time, So this was a pre-participation exemption, accounting treatment.
Yeah.
And this can happen not only because of the 2% additional investment. I'll give you one more example. Like, for example, in the initial, at the beginning of the year, the 5% condition was being met. Think of it this way, Abbas. The 5% condition was being met. 5% or 4 million dirham condition was being met. You had already made enough investment in Mujaddid Corporation USA. Okay, Haya Company LLC had made that investment. But the only thing is that intention to hold was not there, because they were getting information that this Mujaddid Corporation is in financial trouble. So intention to hold for an uninterrupted period of 12 months was not there, right? And the time passed on, and then suddenly Haya LLC found out that Mujaddid Corporation is doing very well. They suddenly got big contracts, and the intention came back, right? So yeah, this is a circumstantial change. Even then, it will not be allowed, right? And the reason or the rationale would be that probably what I understand is circumstantial change is the reason. Because previously, and secondly, an actual action has consequence as well. So if this company had already booked an impairment loss, it was an actual action which has a consequence. That consequence is that participation exemption will no longer be there. On a practical note, to be quite honest, unless it is a listed entity whose accounts are submitted on a stock exchange, or for that matter, if it is a regulated entity like a bank or insurance company whose quarterlies or monthlies are provided to the regulator, if it is otherwise a privately held company or even an LLC who does not file their financial statement, you have the full year to correct it. So until the end of the year, probably most of the companies will, reverse that impairment loss, and they will say that we did not book that. But again, again, that will be it will be still a risky affair, because if you had actually booked a transaction with that impairment loss, this is an evidence that you had already recognized it. Do you agree with that, Abbas?
Yeah. Mm. But still, I just don't understand. I get your point that your point regarding pre-tax losses, but okay, fair enough. But okay, it's something we did in the past. But okay, if let's say we're not even claiming those expenses, or let's say in our next return, we sort of reverse those expenses that we had, the impairment loss that we had claimed previously. So even in that case, you cannot now claim the exemption
So, see,
because
unfortunately,
basically,
let
so go on.
yeah, see, what I'm going to answer you is strictly from a tax practitioner's point of view. Why? Because as practitioners, you are sitting in Deloitte, mashallah, you're in a great place, and I think we all know, even Haya or other people who are here on the call, we all go with the prudent principle, right? Whenever we are taking a call,
Mm,
consider the adverse situation, that what could happen in the given scenario. While rationale is a very important thing, I totally agree. But what I'm saying is from a tax authority perspective. And how does tax authority respond to this situation? What they do is they respond to it from the perspective of what is written in black and white in the provision of the law, right? Rationale is a different thing. What you are asking, or what your question is based on the rationale of lawmaking, right?
yeah, exactly.
Although yes, it connects with it, but yes, rationale of lawmaking would be that yes, I mean, the economic reality is that the year has not completed. In the earlier part of the year, we booked an impairment loss, and before completion of the year, we are reversing it. That may still be a gray area that may be taken up with FTA or challenged with FTA, that look, we reversed the loss before the year end was closed. What will be the answer of FTA? They will revert back like people without, who don't want to think, who want to follow the letter of the law, saying that, look, what does the law say? did you or did you not book an impairment loss? What will be our answer then in that case? Actually,
We did
we
book
did.
the loss.
And that's where we are going to lose. But yes, I do agree with what you're saying. It should be there is further guidance needed from FTA on this. That during the course of year, if all other conditions are being met, like the 12-month uninterrupted holding is being met, the 5% criteria was being met. But your question, the answer to your question is pretty straightforward. If you really think about it, at that time, the criteria 5% was also not being met, right? So
No,
at
no, it
then
wasn't
it
met.
would have been out of question at that, considering for participation exemption for
Exactly.
3% interest was out of question. So, our consideration for, what do you say, participation exemption would even start when we start holding 5%. So from that point onward, we're going to look at the 12-month holding period, or at least an intention to hold it. But again, yes, I mean, there are areas in which further guidance is still needed from FTA. So,
Okay,
anyways,
thank you.
if the country in which but I think we all after, as a result of all this discussion, at least we know, while the topic is open to debate, but if we are sitting in an actual practice scenario, I think we know what to do. Like in
Yes.
this scenario, it is an overriding principle that in any practice scenario or a decision making scenario, we always have to refer back to the letters of the law. And yes, we have to refer to the spirit of the law as well. But based on the letter of the law, we should anticipate the answer from Federal Tax Authority, because they are going to revert back on the letter of the law. They're going to say that did you actually book the impairment loss or not? And we will have no other answer to give except acknowledging it. Yes, we booked it. So the very next answer would be, if you booked it, you don't have the exemption during this year. So that will be the answer. But
Okay,
anyways,
thank you.
if the country in which the participation is tax resident allows it, this we discussed. Example, this also we have discussed. A UAE taxable juridical LLC pays $2 million in 2023 for the stock in an Italian shoe manufacturer. So this is the investment, $2 million. Due to the uncertain political climate, the stock was impaired in the books by 500,000 in 2024 tax period, and a deduction was allowed for that 500,000 in calculating the LLC's taxable income. In 2025, next year, the company is sold for $3 million, generating a 1.5 million profit. Since 500,000 had been deducted as an impairment cost in 2024, only $1 million of the profit would be potentially participation exemption. So, how much gain was it there? The company sold, sold for 3 million, generating a 1.5 million profit. So, you see from this example, what is happening is that it's if you really think about it, Mujaddid, this is a lenient treatment. The example that has been given, if it were actually the decision of the FTA or conclusion of the FTA, it is a lenient treatment. Why? Because FTA is saying that in 2024 you booked a 500,000 dirhams worth of impairment. So ideally, we should not allow you any participation exemption, but we are going to be lenient, and we're going to allow you, out of this entire $1.5 million worth of profit, we are still going to allow you 1 million. And the logic or the rationale why we are not allowing you that additional $500,000 worth of exemption is because exact amount you claimed as deduction in the previous year. Right? So that's the view that the course writer has provided, and I think this is a fair treatment. Where the impairment, any questions up till now by anyone? Where the impairment loss referred to in Article 23 6C is reversed in a subsequent tax period, the associated income reversed. This is what you were talking about. The associated income of the taxable person shall be exempt from corporate tax in that tax period up to the amount of income from the participation interest that was not exempted. So just like we saw in the example. Okay. Non-applicability of the exemption. The exemption under the article does not apply to a loss realized on the liquidation of a participation. So why would a loss on liquidation of a participation not be exempted, and what will be the consequence of this? That's a very interesting point if you really think about it. Exemption under this article does not apply to a loss. Why would a loss be exempt, or how would the loss be treated in case of in the context of exemption realized on the liquidation of a participation? Can somebody say this? Give a feedback about. See, how do we use losses in corporate tax law? We use them to offset, right, our taxable profits. So when we say that exemption under this article does not apply to a loss, what are we saying? How does an exemption apply to a loss? Can somebody give this answer?
Basically,
We
the
can claim the loss.
We will add back the loss to calculate the taxable income, because we are exempting the participation.
So what you're saying is we ideally, if there is a loss relating to an exempt, investment or such an asset which generates exempt income, that loss should be ideally disregarded, right? That's the normal treatment, right?
yes.
Yeah.
But this article apparently is saying that the benefit of that loss will still be available because the exemption will not apply in this scenario. Let us read through. Let's see. The exemption under this article shall not apply for a period of 2 years where a participation was acquired in exchange for the transfer of an ownership interest that did not meet the conditions of Article 23, or a transfer that was exempted under Article 26 or 27 of the decree law. Let's see what are the Articles 26 and 27 of the decree law. Article 26
is transfers within a qualifying group.
is it?
Yes.
Group. Okay, 26.
And 27 is business restructuring relief.
Right. Okay, very good. So let us read again. Exemption under this article shall not apply for a period of 2 years. So the benefit of this exemption will not be available for 2 years, where a participation was acquired in exchange for the transfer of an ownership interest that did not meet the conditions of Article 23. First of all, we acquired some shares, let's say, and those shares did not meet Article 23 conditions of 5% or 12 months, etc. Those conditions were not being met, or the transfer was exempted under Article 26, 27. So there are two articles. One is called qualifying group, transfers of assets within qualifying groups. So what are qualifying groups? In short, when two companies have common control, okay, and same shareholder is there, or up to 75%. One company owns 75% shares in the other company, or a third person owns 75%, at least 75% shares in both companies. Then such companies are called they can be seen as a qualifying group. Okay, so if one company transfers shares to the other company within that qualifying group, then this participation exemption will not be available. Same thing goes for the restructuring. So under the UAE corporate tax law, if restructuring happens and such assets were transferred during a restructuring transaction, this exemption will not be available. When a participation is acquired in exchange for a participation which would not have satisfied the exemption provisions, the holding period is extended to 24 months from 12 months. So in such a case, qualifying relief, qualifying group or restructuring, the time duration is not 12 months but 24 months. Holding of the shares must happen for 24 months of uninterrupted period. Failure to hold 5% or greater ownership. Where a taxable person fails to hold a 5% or greater ownership interest in the participation of an uninterrupted period for at least 12 months, any income previously not taken into account under this article shall be included in the calculation. So basically, it's a, what do you call it? Clawback kind of a clause, right? So you claimed an exemption, but you did not hold this for an uninterrupted period of 12 months. For example, 2024 return, we were filing, and in that return we claimed a participation exemption for some foreign dividends, right? But the time duration of holding was not 12 months, but we had included that exemption on the basis of intention to hold, right? And the very next year, first month, we disposed of that investment. We did not hold it for the planned 12-month duration. What will happen in 2025 return? The exemption that we had claimed in 2024, it will be clawed back, it will be reversed, and it will be taxed. Clear? This provision means that if a foreign company, say, declares dividend, which was exempted as the taxable person had intention to hold the participating interest, but the ownership later reduced to less than 5%, then the dividend is not covered under the participation exemption. We still haven't come to that decision, but we will. It is mentioned. Now we have come. The Ministry of Finance may prescribe that an ownership interest in the shares or capital of a juridical person meet the minimum ownership requirement where the acquisition cost of that ownership interest exceeds the threshold specified in this decision 116 of 2023, and that was later on identified as at least 4 million dirhams. Okay, so that point I have already discussed with you. Are there any questions or feedback or discussion points until now? So what we just studied, Article 23, if you ask me, the entire corporate tax decree law, the most difficult wording was used in Article 23. Whenever you get a chance later on, open Article 23 and try to read it. It's relatively a difficult language that has been put in there, but I tried to keep it simplified. But if you guys ever face any further difficulties, more than welcome to WhatsApp me or get on a call with me. Okay, we are coming to the next thing, which is foreign permanent establishment. Now the easier part starts. Article 24. Let me ask you guys, what is a foreign permanent establishment? One example, any example? Momin, what is a foreign permanent establishment? It looks like Mr. Momin is there, but he's not there. Any other person who can give me the answer? Okay, if you guys cannot give me the answer of what is, yeah.
It's a place of business within UAE by the foreign entities. Like they are not registered here as a juridical person, but they have a place of business in UAE.
Yeah. So what is a permanent establishment? Just a recap. What is permanent establishment? Permanent establishment, that's an easy concept. Fixed place of business. We discussed many times. We've discussed. Permanent establishment is a fixed place of business usually, or a dependent agent operating somewhere, or maybe a nexus. These are the examples of permanent establishment. What is foreign permanent establishment? It is a fixed place, or it's an the business presence of the UAE taxable person in another country other than UAE. That's foreign permanent establishment. Okay, so uh, let me save some time here because this is an easier concept. Resident person can make an exemption to not take into account the income and associated expenditure of foreign permanent establishments in determining their taxable income. A foreign permanent establishment is a place of business or other form of presence outside the UAE of a resident person that is determined in accordance with the criteria prescribed in Article 14 of the decree law. Let us quickly read the example. Article 14 is on permanent establishment. Am I right, Haya?
Yes.
A UAE taxable juridical person LLC opens a clothing factory in Hong Kong in 2023. In 24, the factory produced a net profit of 2.5 million Hong Kong dollars and paid Hong Kong tax at 16.5% rate on the profits above the 2 million Hong Kong dollars and 8.5% on profits up to 2 million Hong Kong dollars. So two progressive slabs. The branch files an election with the FTA to exempt the Hong Kong profits from being liable to the 9% taxation in corporation profits. So you can keep the Hong Kong profits in Hong Kong and not include them or consider them in UAE. There are two methods of double taxation relief. Which is this method that we just read in this example? 10 times we've discussed this. There are two dominant methods of double taxation relief. And this example is one of those methods.
The exemption method.
Haya, Mujaddid, is this exemption method or another method?
Exemption.
Exemption. What about you, Mujaddid?
Actually, there is 8.5% because there's a condition of having similar to claim the relief, having a similar 9% or more tax
No,
rate.
there
So
is
I'm
a
confused in this.
there is a 16.5% as well. So in Hong Kong, there is progressive taxation. So any any revenue, any taxable income above 2 million is taxed at a very high rate, 16.5, and the rest of it is taxed at 8.5%. But the company is not has decided not to include the revenue into UAE books and keep it exempt out of the UAE corporate tax return. So is this an exemption method or another method of double taxation relief to keep out of the books? This is exemption method, guys. If you got both of you are right, this is exemption method. So what we are doing is for our foreign branch, foreign permanent establishment, we have a choice. This is choice number one. Keep it outside UAE. Don't include it or bring it into the corporate tax return of UAE. Exemption method. Now, what is the other method, if I may ask Mujaddid?
The other method is you bring the profit uh, under UAE legislation and you taxed it at 9% and then claim the relief of whatever you paid outside the UAE.
What is the nomenclature that tax practitioners or tax frameworks around the world use? What do we call this second approach?
Foreign tax relief.
Anybody else? Mujaddid, Abbas?
Tax credit.
Tax credit method. So two methods, tax credit method and tax exemption method. Okay. Okay. Article 24. Article 24 applies a resident person shall not take into account the following items in determining its taxable income or corporate tax payable for a tax period. What is Article 24, by the way?
Foreign permanent,
Foreign permanent
establishment
establishment exemption.
Losses in any of the foreign permanent establishment, we don't bring it. Positive income and associated expenditure, we don't bring it into our corporate tax return. Any foreign tax credit, we don't bring it. That's the summary of it. We don't have to go. Transfer from the UAE head office to the foreign branch of the assets and liabilities are to occur at market value. Just one important point we should remember and consider is the transfer pricing aspects. So, because that foreign branch is under our control, under the UAE taxpayers' control, you can manipulate the profits of that, right? So, attribution, a lot has been written. Actually, a full-fledged document is there, published by OECD on attribution of profits to permanent establishments. There's a full guideline available on it. So, and that envisages transfer pricing rules or arm's length principle. So, whenever you are dealing with a foreign permanent establishment, we need to make sure that the transactions are at arm's length. So these two methods, either exemption method or tax credit method, are a subsequent stage. Do you know what is the first stage? First stage is that during the course of the year, all the transactions that we did with the foreign permanent establishment, we need to ensure that they are carried at arm's length principle. Because this compliance does not care about what choice we are opting, whether we want to use the tax credit method or tax exemption method. It doesn't, I mean, the arm's length principle is above and beyond that. It is mandatory and there is no exception to this rule. So the transactions must be at arm's length. Let us look at an example. Since 1985, a UAE taxable juridical LLC manufactures tires in Sharjah. Okay, in April, the LLC decides to establish a tire manufacturing factory in Jordan and close the Sharjah factory. And in October 24, relocates the plant to Jordan. At the relocation date, the plant was valued at 15 million dirhams and was in the books at 3.5 million dirhams. The AD 11.5 million gain is booked in the financial statements as income and will be included in the company's taxable income. So, that's a very interesting example. Why? Because we have to book it at arm's length basis. Income and associated expenditure. For the income and associated expenditure of a taxable person's foreign PE for a tax period is the aggregate of the income and expenditure in each of the relevant jurisdictions. Okay, in determining the income and associated expenditure of a foreign permanent establishment, a resident person and each of the foreign permanent establishment shall be treated as separate and independent persons. So we have to look at them as separate persons. The excluded income and associated expenditure for all of the person's foreign permanent establishment are to be aggregated, and the income and associated expenditure are calculated by applying the separate and independent persons concept. Is it a pick and choose method, or do we need to include or exclude all foreign permanent establishment? Let us read through.
All.
Yeah, all. To be all. It is not a pick and choose. The decree law does not define the separate and independent persons test, and in that absence, the meaning of that concept in the OECD Model Tax Convention is likely to be applicable. The Article 5 of the commentary provides that these profits are the profits that the permanent establishment might be expected to make if it were a separate and independent enterprise. So basically, all we are saying is that the permanent establishment has to be seen as a separate company, a separate taxable person. The basic approach incorporated in the paragraph for the purpose of determining what are profits that are attributable to the permanent establishment is therefore to require the determination of net profits under the fiction that the permanent establishment is a separate enterprise. So, how do we attribute profits to permanent establishments? Let me give you a hint. It's usually a 3-word approach. FAR. Have you guys heard about it? The FAR analysis.
No.
Abbas, what about you?
No, I'm not about it.
Functions, assets, risks. So when you're looking at attributing the extent of income or profits to your permanent establishments, or for that matter, foreign permanent establishments, these are the 3 main criteria: functions, assets, and risks. So for various projects or for the purpose of business, what kind of functions are exercised or performed by a particular branch? How much assets does it own? Like, because of assets, we earn income, right? Income is earned on top of assets. And then risk, how much amount of business risk that particular establishment assumes. So that is these 3 criteria usually determine what amount of revenue or profit should be attributed to that branch for analysis.
Sorry, just one question. So we said that we don't have the pick and choose method, right? So in that case, why would we be worried about the attributing it to each and every branch?
Because when I say we don't do pick and choose, what I was saying was, especially in case of Article 24, which is what? Foreign permanent establishment exemption, especially, right?
Yeah.
We are excluding the profits from UAE books. What if there was a profit shifting done, Abbas? Right? You get my point. In the other method, the tax credit method, that's where your point will apply. Because in that particular case, we are bringing that income into the books of UAE.
So okay, so in this case, we are only discussing about
Exemption.
income earned between, let's say, the UAE company and its fund and its FP, basically.
Yes, correct. And
Okay,
especially
okay.
this, what you just highlighted, and it was a valuable point, and I want other participants to understand what Abbas has just highlighted. And you carefully understand what Abbas was trying to say. That why are we, if all income is to be pooled, then what do we care about whether we pick and choose or not pick and choose? So the answer was that, especially in case of exemption, when we exclude the incomes and profits of foreign permanent establishment, what happens? Then we don't levy UAE corporate tax on that, right? And that means if we had shifted profits to a jurisdiction, or for that matter shifted losses to a jurisdiction, that would create a transfer pricing problem, that would create a tax avoidance scheme, possibly, if we were corrupt, if we were trying to avoid tax. Like, take the example of Singapore, or what was that, Hong Kong company, where there was a higher tax, right? What would be our intention? Pay less tax in Hong Kong and shift profits to UAE. Don't you think so? Right?
Yes.
So in that case, we will try to create that scenario where Hong Kong branch can invoice inflated invoice send inflated invoices to uh, no, other way around. The UAE company can send inflated invoices to Hong Kong company. So in that way, larger revenue is booked in UAE, and the cost of sales of the Hong Kong company goes up. That means the profit reduces in Hong Kong. So higher rate of tax, which is there in Hong Kong, cannot do much damage, because then the bottom line profit will be reduced. So this is a profit shifting, fraud that we are doing. So that's why the exemption method, especially, it is designed in that sense that, we either adopt the foreign permanent establishment exemption at an entity-wide level or otherwise.
Which means if we have different P's, so we need to choose one method for all P's. The are like we cannot pick and choose. Like for one P, there's exempt method, or for the other P,
Yeah,
they
but then it begs one more question, Haya. Let me ask another question. Although, I mean, this is a predominant discussion, but let me ask you something. What a UAE company has a branch in BVI, British Virgin Islands. Okay. What
okay.
happened in that case?
That's the tax haven.
That's a tax haven, right? So what
Yes,
we are choosing the exemption method. What happens?
it won't tax over there. It's a tax free,
It's it
and
it goes it goes tax free, right? In that
yeah,
there has to be some there has to be a criteria that has to be applied there, isn't it? So I think this was Article 24, right? So I'm sure they have mentioned this point there, because otherwise it will beat the whole purpose. So there has to be a tax that is levied there in the foreign permanent establishment in order for this exemption to work, because otherwise entire business will be shifted to such permanent establishments where there is no corporate tax. As a matter of fact, we can look into the Article 24. Let us quickly, this is 23. Let us have a look at it, because otherwise, I mean, I cannot believe that this will not be provided for. So this is Article 24. So if you continue to look at it, associated expenditure, available income.
yes, it's clause 7 of Article 24,
Is subject to a tax. Yeah, there you go. That's
the
why.
exemption. Yeah,
Otherwise, it will not make sense.
yeah,
Clause 7
got it.
identify the exemption under this article shall apply only to a foreign permanent establishment that is subject to corporate tax or a tax of similar character under the applicable. If this if this clause was not there in Article 24, what will be the result of this? All the UAE companies would shift, as much business possible to tax havens, and then they will go for the exemption method for foreign permit establishment.
Yeah,
So that will mean they don't pay any tax. So anyways, yeah, this we also read. Where are we? We were talking about exemptions. To be exempt from UAE corporate tax, the net income of the foreign permanent establishment is to be subject to tax in the relevant foreign jurisdiction at a rate not less than the 9% rate. So this also we've done. Let us go to the next. Okay, one of the special exemptions, international shipping and transportation, basically. Non-resident person operating aircraft or ships in international transportation, which is Article 25 of the Corporate Tax Decree Law. If you guys have ever read the Model Tax Convention, and I'm sure some of you have, you might have read there is a specific article in Model Tax Convention, right, on international shipping and transportation. Same thing was adopted by UAE as well. So the exemption is that income derived by a non-resident person from the operation of aircraft or ships in international transportation shall not be subject to UAE corporate tax where all of the following conditions are met. Uh, the non-resident person is in the business of any of the following three businesses. Number one, international transport of passenger, livestock, mail, parcels, merchandise, or goods by air or by sea. So international cargo, basically. Second, leasing or chartering aircraft or ships used in international transportation. And the third one, leasing of equipment which are integral to the seaworthiness of the ships or airworthiness of aircrafts. So these are the three businesses which can enjoy the exemption. But what are the conditions of exemption? I think reciprocity will be one condition. The exemption has to be reciprocal. A resident person that performs any of the activities would be exempt or not subject to tax that is of a similar character to corporate tax under the applicable legislation of the country or territory in which the non-resident person is resident. Uh, the person who is operating such, aircraft and ships, etc., should be exempt in the home country, first of all. Secondly, therefore, a non-resident aircraft or shipping company is not liable to UAE corporate tax on profits arising from the transportation of people, goods, all that merchandise, equipment carrying on the same or similar function is not liable to tax in the country in which the non-resident is tax resident. So that other country also exempts the same person. But there is another condition of reciprocity. I think it will come later on. Absent further explanation of the meaning of Article 25, assistance is available from reviewing the OECD commentary to Article 8 of the convention. Article 8 addresses international transportation. The object of Article 8 to secure that such profits will be taxed in one state alone. The provision is based on the principle that the taxing right shall be left to the contracting state of the enterprise. Yeah, so one of the two countries is going to tax the international shipping and transportation. The Article 25 concession is worded more descriptively than that adopted by the UAE in the most recently published UAE Double Tax Convention, UAE Israel Double, in which the concession is written as a profit of an enterprise of a contracting state from the operation of ships or aircraft in international traffic shall be taxable only in the state. And B, the provision of paragraph 1 shall also apply to profits from participation in a pool, joint business, or international operating agency. Let us read the example then. A French company transporting passengers from Dubai airport to Paris, France, books in its Dubai branch 5 million dirhams profit attributable to the transportation of the passengers and claims an exemption from UAE corporation tax. FTA identifies that a UAE airline transporting passengers from Paris to Abu Dhabi makes 2 million euro profit on the transportation of those passengers. If the UAE company is taxed in France, the French airline company will not be exempt. So that is the condition of reciprocity. If UAE is giving an exemption to the other country's shipping company or air company, same kind of a treatment should be extended by the other company to UAE companies, Emirates Airline or other shipping corporations. Now we're coming to this is a very key article, guys. This Article 26, and it is a hidden treasure, if you really think about it. But again, we'll look at the on-ground complexities. Transfers within a qualifying group. Let us read through. In this section, so what are we doing here? In this course, what we are learning about corporate tax strategy as well. We advise clients on what is the best route to take. In this section, you will learn about the provisions setting out the taxing consequences of assets and liabilities being transferred within a qualifying group. So you guys remember what was qualifying group? I just explained some a little time ago. Kalima, can you respond to it?
They have when 2 or 3 companies have common ownership.
And what is the percentage of ownership?
70%.
75%.
75. Okay.
Provision of Article 26 must be read with Ministerial Decision number 132 of 2023 on transfers within a qualifying group for the purpose of decree law. No gain or loss need to be taken into account in determining the taxable income in relation to transfers transfer of one or more assets or liabilities between two taxable persons that are members of the same qualifying group. That's an easy, but still will an AED 500,000 profit derived when company A transferred a Dubai sited building crane to company B in the circumstances in which both company A and B are members of the same qualifying group is potentially free from UAE taxes on corporation profits. So if there was a gain or loss on the transfer of title to the property in this crane from company A to company B, that gain or loss, even if it is booked in the financial statements, it will not be booked or reported in the corporate tax return. Why? Because this was a qualifying group. Clear, guys? It will be booked in the financial statements, chances are, but preparing the corporate tax return, you will exclude the gain or loss. So, what are qualifying groups? Two taxable persons shall be treated as a member of the same qualifying group where all the following 6 conditions are met. Taxable persons are, first of all, what? Juridical persons that are resident persons, meaning non-resident persons are excluded, or non-resident persons that have a permanent establishment in the state. So, my question, can a branch be a qualifying group, part of a qualifying group? UAE branch. Come on, guys, that's an easy one. The taxable persons are juridical persons that are resident persons or non-resident persons that have permanent establishments in the state, in the UAE. So my
Yes,
question,
they can be part of.
they can be, yes. So whenever we use the word branch, we are referring to a non-resident person. Why? Because branches usually are of non-resident persons.
Just one small question. So, when we say or non-resident persons that have a permanent establishment in the state, so that would mean that not. So here, are we talking about the branch in the UAE, or the company who owns this branch in the UAE,
So
which would be the foreign company?
yes, you are right, Abbas. We are talking about that non-resident person because if you really look at the trade license of the branch itself, what is written there is the name of that non-resident person and then the words branch or whatever is mentioned. So actually that non-resident person has the presence in UAE. So the branch in itself is like it's an extension of that non-resident.
Exactly. Yeah.
You're right.
Okay.
Either taxable person has a direct or indirect ownership interest of at least 75% in the other taxable person, or a third person has a direct or indirect ownership interest of at least 75% in each of the taxable persons. Is the concept of this paragraph clear to everyone? It can be only one company owning 75% in the other company, or a third person owning 75% at least in each of those companies. Another condition is none of the persons are an exempt person or qualifying free zone person. Why? Exempt persons are already exempt. They are not subject to tax. Qualifying free zone person are effectively exempt. But I mean, just a fun question. Can we call qualifying free zone persons as exempt persons?
No.
What about you, Mujaddid?
No, they are taxed, but at 0%.
0%, right? Very good. So I think all of us are clear that the common language that we use, yeah, qualifying free zone persons are exempt already. That's the wrong language. Qualifying free zone persons are 0 rated persons, not exempt persons. The financial year, now this is a key point. The financial year, the period specified in Article 57 of the law, namely the Gregorian calendar year or 12 months period for which the taxable person prepares the financial statement of each of the taxable persons ends on the same date. Ends on the same date. So basically same financial year. Both taxable persons prepare their financial statements using the same accounting standards. Okay. So these 6 conditions have to be met in order for two or more companies to be construed as qualifying group. And what will be the consequence once those two or more companies are successful in achieving the status of a qualifying group? What is the consequence, tax consequence? No gain or loss rule is intended to ensure that assets can generally be moved around a group of companies without any immediate capital gains consequences. So in case there are gains, it is only the upside of it. It will not be taxed. The downside of it is that if there's a loss, that will also be not considered. So in any transaction, if one company is incurring a gain, uh, not necessarily the other company may be incurring a loss. Why? Because it may be a transfer of ownership situation. So the asset is transferred at fair value. So other company is recording a neutral transaction. They are acquiring an asset at a fair market value. So there is no, from their perspective, no gain loss. But the company who was the owner, who was transferring that asset, they may incur a gain or loss. Why? Because the net book value may be much less than the fair value of the asset that is being transferred. But under the qualifying group doctrine, they will benefit. They will not need to record that gain, or they will record in their IFRS financial statement, yes, but when they're reporting it in their corporate tax return, they will exclude it. This recognizes that business activities carried on within the overall economic ownership of the group should, in broad terms, be tax neutral. So that's the whole point. This is tax neutral transaction. This is achieved by fixing both the consideration received for the asset by the transferor and the consideration given for the asset by the transferee at the net book value. In this way, the transferor has no chargeable gain nor allowable loss. Okay, let us read an example and then maybe I will ask something. Referring back to the crane example, if both company A and B are UAE juridical persons, there is 80% commonality of shareholding between the company A and B. Neither company A nor company B is an exempt person, and neither is a qualifying free zone person, and both have accounting period. All conditions are being met, in short, and both use IFRS. Then the 500,000 profit should be tax free. Were company B a qualifying free zone person, then AED 500,000 would be included in the company A's taxable income. Let's see. Were company B a qualifying free zone person, then the 500,000 would be included in the company A's taxable income. Did you guys understood this last sentence?
Yes.
Yeah.
So if the other company was an exempt person or a qualifying free zone person, then that additional, the 500,000 dirhams would be taxed in the books of company A, the seller. For the purpose of the decree where a taxable person applies Article 26, the following two rules shall be true. Rule 1, asset or liability shall be treated as being transferred at its net book value at the time of transfer to the other.
Mr. Altaf,
Yes.
when two companies are there in a qualifying group, do they file their return as a combined return or like individually they would file?
Very good question.
Group return.
Yes, Haya, you're saying something? Yes.
Group return would be filed if they are registered as a
Anybody else?
tax group.
Anybody else? Mujaddid, what do you think? For a qualifying group, will there be one tax return or more?
It will be more because one tax return will be if they are registered as a tax group having 95% or more on it.
Correct. That's the correct answer. So, what is the upside and what is the downside of having a qualifying group?
The upside is like you, for example, if you are as a tax group, so whole group will be applied 375 threshold. But in case of qualifying, you can claim on individual level 375. So in this case, you will have a benefit of claiming more 0%
You
taxable
guys
income.
understand this, what just Mujaddid said? So two companies are there. Each company, because they are filing two separate tax returns, they have two TRNs, they are separate taxpayers. Each of them has 375,000 dirhams worth of zero rating slab available, taxable income zero rating slab. But when they form a tax group, which is not a qualifying group, the tax group is different from qualifying group. We're going to read it in the next part. Okay. If that scenario exists, what happens? Tax group only gets one 375,000 dirham slab, which is applied, which attracts zero rate. So that's a loss that tax group faces, but qualifying group does not face. But what is the benefit? In tax group, you can offset the two companies loss against profits. One company is profitable, other company is loss making. You can offset, right? Same thing you can do in qualifying group as well. Okay. In qualifying group, you can transfer your tax loss from one company to another company. Probably we're going to read that later on. So then what is different then? If you can achieve the same objective of transferring your tax loss from one company to the other company, and the same thing you can achieve through tax group as well, then what is beneficial then? If you really think about it, in qualifying group, not only can you transfer your tax loss from one company to the other company, but you are getting that zero rating slab of 375,000 not once but two times in two companies. Don't you think qualifying group would be a better scenario than tax group? Mujaddid, what do you think?
Yes, in this case, this is a better scenario.
That you have the ability to transfer tax loss from one company to the other company in case of a qualifying group. You are getting 375K plus 375K of zero rating slabs in each of those two companies. But in tax group, you're getting only one slab of 375K. So at the outset, it seems that the qualifying group has slightly larger advantage. But okay, fine. I think most of us understand this point. Let me ask the downside of the qualifying group, which is not present, which is not there in the tax group. There's a major advantage that the tax group has, but the qualifying group does not have. Can somebody tell me that?
Is that the consolidated filing is not possible, like you said. We have to individually file the returns.
Uh, okay, this is only 25% of the answer because there's a bigger concern here. When you're filing two separate returns between a qualifying group, which has 75% common interest, can somebody think out of the box? Because this requires a larger view of things. Can somebody tell me? There's a downside in qualifying groups, which is not present in tax group. Arm's length rule, transfer pricing. Why? Because qualifying groups will will be related parties. You agree with me? Both companies have 75% common shareholding. Doesn't that make them related parties? If it
Yes.
if they are related parties,
Yes.
then any transactions between these two companies will be subject to arm's length principle, and it will create a significant compliance exposure on part of this group, where any non-compliance will be dealt strictly by the Federal Tax Authority. But in case of a tax group, this very significant exposure completely wipes out because it is one fiscal entity, it's change of pockets. So that we need to remember. And I'm telling you from a practical perspective, significantly large entities that I have served as tax advisor, they let go of certain tax benefit that was apparent to them from a qualifying group perspective. They said, okay, we don't care about this 50,000 dirhams worth of benefit to us. If we form the qualifying group, we will ignore this. And even if we have to lose this 50,000 dirham or some other benefit, we are going to go for a tax group just to avoid the transfer pricing compliance hassle or transfer pricing risk. So that transfer pricing, guys, we need to remember when we're advising clients, we need to remember that transfer pricing risk is a huge decision-making criteria. And most of the companies are so afraid that they go for tax group, even though some level of monetary benefit may be available in qualifying groups, just to avoid transfer pricing risk. Okay. Rule number 2, the value of
I think there is one more area we can look at. It is, for example, in the tax group, the carry forward loss of one entity can be offset against the other one, I guess. And the qualifying,
yes, good
it's
point.
not the case yet.
Good point raised. This is coming up. We will read what is that 75% rule. Soon we will read that.
Okay.
Let's go forward. Rule 2, the value of any consideration paid or received against the transfer of the assets or liability shall equal the net book value of the transferred asset. That we read, fine. So consideration will be seen as equal to the net book value of the asset that was transferred between the qualifying groups. Okay. Non-applicability of this Article 26, where does it come in? Let us have a look at it. Provisions of Article 26, which is transfers within qualifying group, shall not apply where within 2 years from the date of transfer, any of the following two events occur. There is a subsequent transfer of assets or liability within 2 years. So that's a that's a holding period specified. So until 2 years, you cannot, further transfer the asset outside the qualifying group. And taxable persons cease to be member of the same qualifying group. So, what would be the reason that a taxable person ceases to be member of the qualifying group? Chances are that the, 75% shareholding threshold may dilute and go below, or, I think this is the main, criteria, 75% shareholding. So if that, or it becomes a qualifying free zone person, or it becomes an exempt person, so that it can no longer be a part of those 6 conditions that are there. If we lose any of those 6 conditions and the person moves out of the qualifying group, then there will be a clawback on the profit or on the gains that we had claimed as exempt. We will have to report it and pay tax on it. Market value is the price which can be agreed in an arm's length free market transaction between persons who are not related parties or connected persons in similar circumstances. A recapture rule applies, recapture or clawback, also you might call it, applies if within 2 years of the qualifying transfer, the asset or liability leaves the qualifying group. So, recapture rule will apply. We did not book a gain at the time of transfer of assets within qualifying group, but that asset was later on further disposed of by the buying party, right? Within two years time. So if that happens, then the original seller will need to book the gain as a taxable component of income. So they have given a UK provision as well. UAE clawback is more generous than the UK clawback, which which applies when the purchaser ceases to be a member of the same group as the vendor within 3 years of the effective date of the intragroup transaction, if the purchaser or relevant associate company still owns the property. So I think 3 years rule is there in UK. Assume the crane that in the intragroup transfer gave rise to 500,000 exempt profit in 18 months, later sold to company C, which has 55% shareholding commonality with company A and B. So 55% is not the same as 75%, right? So this company C is not part of the qualifying group. In these circumstances, the 500,000 tax-free gain would be included in company A's taxable income because 2 years holding period was not met. Now we are coming to the next article, which is business restructuring relief, which is Article 27. Let us have a look at it. In this section, you will learn about the provisions setting out the taxing sequences of a business ownership being restructured using stock as consideration. The provisions of Article 27 must be read with Ministerial Decision number 133 of 2023 on business restructuring relief for the purpose of federal decree. No gain or loss needs to be taken into account in determining the taxable income in any of the following two circumstances. So what are those circumstances? Taxable person transfers its entire business or an independent part of its business to another person who is either a taxable person or will become a taxable person as a result of the transfer in exchange for shares or other ownership interests of the taxable person, that is the transferee. That's the first scenario. And the second one or more taxable persons transfer their entire business to another person who is a taxable person or will become a taxable person as a result of the transfer in exchange for shares or other ownership interests of the taxable person, that is the transferee, and the taxable person or the persons that are the transfer cease to exist as a result of the transfer. In accounting or company law terms, what do we call this transaction? Can somebody tell me? Cease to exist.
Acquisition.
No, but in acquisition, subsidiary exists.
Liquidation.
Merger then.
In merger is a
Basically,
broad
form a
term.
new company.
Merger, yeah, merger is a new term. So the new, it's a broad term in which it is possible that both entities exist. That's one scenario in merger. Second
Yeah,
scenario is both companies cease to exist, and a third new company is formed.
new
Right?
company is formed. Yeah.
But what is this scenario? Let us read one more time. One or more taxable persons transfer their entire business to another person who is a taxable person or will become a taxable person as a result of the transfer in exchange for shares or other ownership interests of the taxable person, that is the transferee, and the taxable person or persons that are the transferor cease to exist. This actually, guys, is known as an absorption. So there is acquisition, there is merger, many other, the different scenarios are there, but absorption is one situation of a business combination where the company which was transferring its business to the acquiring company, they cease to exist. So they transfer all their, net assets to the acquirer and then they liquidate, right? That's an absorption scenario. But what about the first scenario? Taxable person transfers entire business to or part of independent part of the business to another person who is a taxable person or will become a taxable person as a result of the transfer in exchange for shares or other ownership interest, in exchange for share or other ownership interest. So business or independent part of business. So aren't we talking about basically transfer of net assets here? Basically what we are saying is we had for example, let's say manufacturing division or a plant something, and we transferred all of that to another acquirer. So, and we disclosed it in our financial statements as discontinuing operation, or this is being disposed of to another company, right? So this is kind of a transfer of assets to another person. So the both companies are existing as a result of this transaction. But the only difference is that both companies are now restructured. One part of the transferor company has moved to the transferee company. Both companies exist. But in the second scenario, only one company exists. It has taken over.
But then, even in the first scenario, it's still a transfer by exchange of shares. So it's not like So like let's say purely sale of a division.
Yeah, just but please look at the let us have a look at the last part of this. Or as a result of the transfer in exchange for shares. So what are we saying here? Aren't we saying that the shares are being used as a consideration of the transfer? Boss, what do you think? In exchange for shares. Here, what we are saying is
Um,
that the persons from whom we are acquiring the business, because here they did not write, you know, acquisition of shares. That's not what the intent of this article is. It says it is not the what they're saying is we are not acquiring shares of the company. We are acquiring business or independent part of business by issuing our shares to the person who is transferring the business. So basically, we're taking the shareholders on board in exchange of shares or other ownership interests of the taxable person. That is the transferee. Beautiful. Now there should be
yeah,
no doubt about it.
yeah,
Transferee is giving their shares as the price for the acquisition of business or independent part of business. So, anyways, these two scenarios are there, which are business restructuring relief. What does the business restructuring relief involve? A business restructuring involves the transfer of assets, but not all assets of the business. There you go. Does this answer your question, Abbas?
yeah,
That's what I said, net assets.
yeah,
Transfer of assets, but not all the assets of the business from a transferor to a taxable person to a taxable or soon to be taxable transferee. Does not give rise to a taxable gain when the transferee issues shares or other ownership interests to the transferor. So this is a great relief. It's a transaction that will be exempt because this is a relief. Um, no taxable gains or loss will be taken into account. The main difference between Article 27 and Article 26 are that the tax relief applies in Article 27 to non-commonly owned companies. So yeah, so this is a great thing. I mean, here these are two independent companies who are doing a transaction in the business restructuring relief. But under Article 26, that was qualifying groups, 75% ownership. But for it to apply, the transferee must issue shares or other ownership assets to the transferor. Also, Article 26 applies to transfer of one or more assets or liabilities, whereas Asset 27 applies to transfer of entire business or an independent part of business. So you see the difference. Under Article 26, it was qualifying transfer of assets, but Article 27, the name itself tells us business restructuring relief. So we are talking about the transfer of business or an independent part of business. Since the terms and provisions are similar to those embodied in the EU merger directive introduced by the Council directive on the common system of taxation applicable to mergers, divisions, partial divisions, transfer of assets, and exchange of shares concerning companies of different member states, the interpretation of the core concepts in the EU merger directive should be seen as helpful when interpreting Article 27. So there is EU merger directive in short. So the concept of this business restructuring relief has been inspired or taken from that EU merger directive. It remains to be seen whether the Ministry of Finance intends the full range of provisions dealing with mergers, divisions, splits, partial divisions, assets transfers, exchange of shares covered by the EU directive are to be equally applicable in the UAE. Actually, it will be, it will not be easy for Ministry of Finance to, openly accept this. But who knows? Maybe we will see some guidance. Assume in the example of the crane being transferred from company A to company B, that company instead of transferring a single crane transferred to company C, its entire heavy lifting machinery business for 87.5 million dirhams. Book value was also 7.5 million when the business is worth 10 million dirhams, the market value was higher, making a 2.5 million profit. And in exchange, company C issued stock to company A, stock worth 7.5 million dirhams. So the stock that was issued was AD 7.5 million dirhams. In these circumstances, the 2.5 profit would potentially not be included in company A's taxable income. So this is a key, provision that although the net book value of the business was smaller and market value was higher, but for tax purposes, it will be treated at book value. This transfer will be treated at book value. So the person who was transferring was a taxable person. The person who was receiving was also a taxable person or soon to become taxable person. So FTA overall, at an overall level, FTA looks at it, or Ministry of Finance looks at it as a continuation of business. So if in the previous scenario, they were not losing tax. In the new scenario, it will still be a going concern. So that's why they say, okay, fine, it's only a change of ownership. Let's not worry about it and don't tax this transaction itself. The business restructuring involving the transfer of the entire business from the transferor to a taxable or soon to be taxable transferee does not give rise to a taxable gain when the transferee issues shares or other ownership interests to the transferors within the transferors ceasing to exist as a result of the transfer. So if the person who was transferring this, they cease to exist, this is the second scenario. Business restructuring relief involving the transfer of the entire business from a transfer to the taxable person soon to be does not give rise to the taxable gain when the transferor ceases to exist. The main difference between the two articles is Article 27, which is restructuring, and 26, which is qualifying transfers. It is that the tax relief applies in Article 27 to non-commonly owned. This is a repetition. I think we know this point. When does business restructuring take place? Okay, let us have a look at various. The transfer is undertaken in accordance with and meets all the conditions imposed by the applicable legislation of the state. So what is being said here is that commercial company law will apply. So this is the very next sentence. The legislation is set out in section 285 to 293, which is merger, and section 294 to 98, which is division, split basically, of the federal law number 32 of 2021. This federal law number 32 of 2021 is the subsequent or latest version of, if you remember, federal law number 2 of 2015. That was the commercial companies law. So this is the latest commercial companies law issued in 2021. The taxable persons are resident persons or non-resident persons that have a permanent establishment in the state. So same thing, either resident persons or branches of non-resident persons in the UAE. None of the persons are exempt persons. None of the persons are qualifying free zone persons. Quite similar characteristics. Financial year ends on the same date. Then next will be standards. Yeah, accounting standards. And then transfer under Article 27 is undertaken for valid commercial or other non-fiscal reasons which reflect economic reality. This is the only additional rule. Otherwise, previous all rules were similar to qualifying transfers, if you really think about it. So basically it's saying that the purview of this transfer was it had economic reasons. It was not to avoid tax. In terms of the taxation relief in Article 27, do not neatly align with the federal decree law on commercial companies, but it is anticipated that the reliefs offered in 27 are intended to cater for merger and division transactions. And even I think spin-off transactions also. Division, spin-off, I think both are quite aligned. Another example. In the example of the heavy lifting equipment business being transferred by the company A to company C, you remember 2.5 million potential gain was there, would be non-taxable because the condition of the restructure adopted in the plan satisfy sections 294 to 298 of the Commercial Companies Decree Law. Both companies are UAE tax residents. Neither company A or C is an exempt person, and neither is a qualifying free zone person. Why is this example highlighted here? I think you guys have read that, all other conditions are being met, like tax resident, they are not exempt, they are not qualifying free zone person. Both companies have adopted same tax period. They are both preparing IFRS compliant. Then what was the purpose of this example? Can somebody highlight this? Thinking? Do you know why was this point highlighted? Look, what is the topic that we are looking at? When does business restructuring take place? And even before that, actually,
2 years time span.
no, not really 2 years time span. Let me read where it's under the applicable legislation. I think it is here. Let's read here. Yes, this is the one. Look, it says the transfer is undertaken in accordance with and meets all the conditions imposed by what? The applicable legislation of the state. This should be a capital S, but anyways, meaning UAE. So guys, this is an interesting provision. It is provision of corporate tax law, UAE corporate tax decree law, but it alludes to another legislation. And it does not say, any legislation. It says applicable legislation. There can be other legislations as well. In this, usually in majority cases, it is the Commercial Companies Law that is applicable. But what if it is DIFC company? Then the Commercial Companies Law may not apply there. The DIFC law will apply there. Or for that matter, ADGM law will apply there. Applicable legislation. This was a very intricate point. I asked you on purpose just to keep your edges sharp, so that when you are in an actual situation in your practice areas, you should know that sometimes UAE corporate tax decree law refers to outside legislations, like other than the tax legislation. That's what I wanted you to look at. That's why they had highlighted that the restructure adopted the plan to satisfy the conditions 294 to 298 of the Commercial Companies Law. Is this point clear to you guys? It must comply with the commercial legislation, other applicable legislation of the restructuring transaction that is taking place. What other legal thing can come into play? In Pakistan and in India, sometimes how does merger happen? I don't want to use the word. I want you guys to tell me. I'm sure you guys have been, studying there as well. So, what other legal enforceable framework is there for any merger transaction? Sometimes large scale mergers, public mergers.
SCCP.
Court scheme of merger. Have you heard about it? Sometimes the court of jurisdiction, which is usually the High Court, they approve the merger transaction. And which is called the scheme of merger. So that decision also governs, and that may be applicable if it is a public interest entity in UAE. Although it is not written, but chances are that sometimes even the court may issue an order here. Okay, or any other applicable authority may issue another. So that will also be covered under the provision that we read, that the applicable legislation should be complied for that scheme, for that transaction, business combination transaction to take place. So if it is non-compliant with that, then there will be a problem. Then the corporate tax exemption will will be revoked. Okay, key point. Moving to the next. Conditions of business restructuring. For the purpose of Decree Law number 7, where the taxable person applies Article 27, all of the following must be observed. What are these are the conditions of a qualified restructuring transaction. Assets and liabilities transferred shall be treated as being transferred at their net book value at the time of transfer, so that neither gain nor loss arises. The value of shares or ownership interest received under Article 27 shall not exceed the net book value of the assets transferred and liabilities assumed, less the value of any other form of consideration received. The other consideration may include monetary amounts or assumed liabilities. So what are we saying here? Value of shares or ownership interests shall not exceed the net book value of the assets transferred. That is how the book transfer happens. Value of the shares or ownership interest received shall not exceed the book value of the shares or ownership interests surrendered. So, if there is a share swap situation, then the value of both sides shall equate, less the value of any other form of consideration received in cash or in kind. So I think when we studied earlier in our other chapters of financial reporting, etc., when we were studying, business combinations, acquisitions, and mergers, uh, we must have read usually that the value of the shares less any consideration paid in cash or in kind, right? So it should equate. Both sides should equate in order for net book value to take place. Any unutilized tax losses incurred by the taxable person, that is the transferor, prior to the tax period in which the transfer under the Article 27 completes, may become carried forward tax losses of the taxable person, that is the transferee. That's a very important point. And it is sometimes when we are doing tax due diligence, or even considering strategy, this point will play a huge role in our decision. Can you guys, explain in simpler words what is written here?
The transferee's tax losses will become the taxable person's the transferer's tax losses will become the transferee's tax losses moving forward.
That's what is being said here. Haya, do you understand what is said here? A transaction happened, maybe in a merger transaction happened, or an absorption transaction happened, or a split transaction happened, whereby a business or part of the business was taken over by a company, right? And the taxable losses of that business that was taken over, they will become the tax losses of the acquirer, and they will be able to benefit from those tax losses. Don't you think that's a very important consideration while taking the decision to carry out this transaction? Like, you may be reached out by a potential client saying, look, we are planning to acquire this company or this business, but we want to look at the figures before we take a decision. So you will need to embed this point as well, that look, the business segment you are about to acquire has such and such amount of tax losses that can be attributed to it. So if you acquire this, in addition to other things, this one additional aspect will also be there, that you will be able to utilize the tax losses for your already profitable business. So that will give you an advantage. Okay. So it's a strategy.
Yes.
Okay, relief provides for the assets and liabilities to be transferred at net book value, with the stock issued being worth no more than the book value of the assets transferred. When we prepare financial statements, and we kind of want to arrive at the net book value of the net assets, there's a particular jargon we use for the shares. What is that jargon? What value is that? There's a name for the value of the shares. What do we call that? Do we call it nominal value? Do we call it fair value? Do we call it something else? It's a famous name.
Par value.
That par value is nominal value. It is that value which is displayed on the share instrument. Previously, in Stone Age, when share instruments were prepared in paper, it was displayed on that. Nowadays, this is digital, so no need for the paper. But par value, nominal value, it's the same thing. But this is not the value that we are talking about. The value that I am referring to, it's the balance sheet calculation. On one side we have assets, on other sides we have liabilities, etc.
Book value.
Book value.
The NAV.
NAV. Excellent, Abbas. Good show. Net assets value, guys. Come on. Net assets value, NAV value. So basically, NAV value is the total assets minus total liabilities. That gives you the net assets of the company. So you divide it on the number of shares in issue. What you get? NAV, net assets value per share. So this is the net assets value that we are referring to again and again. Abbas, you are very impressive, my dear. MashaAllah.
Thank you.
Good.
Thank you.
Consequently, the losses, if any, incurred in the year of transfer remain within the transferor and in the circumstances in which the transferor is dissolved, being lost. So anyways, basically the whole point of, repeatedly one thing is being said, that find out the net book value, find out the net assets value, and that's how your business restructuring relief will invoke. Provisions of the article shall apply as the context requires, where in the case of transfer under the Article 27(1), following events occur. So provisions will apply if these things happen. What are those things? Share or ownership interests are received by a person other than the taxable person, that is the transferor. Shares or ownership interests are issued or granted by a person other than the taxable person, that is. So what we are here, we are talking about the UBO and agent scenario. Provisions of this article shall apply as the context requires, where in case of a transfer under Article 27(1), any of the following occurs. So it can happen that instead of the only two parties, transfer and transferee, there is a third person which is acting as an agent, right? That's why these things are mentioned here. Shares or ownership interests are received by a person other than the taxable person, that is the transferor. Shares or ownership interests are issued or granted by a person other than the taxable person, which is the transferee, or no shares or ownership interests are received by the taxable person who is a partner in an unincorporated partnership that is treated as a taxable person under Article 16 of the decree law. There is an exception. If you guys remember, an unincorporated partnership can go to FTA and say that, look, we know that our default treatment is that the incomes will be taxable in the hands of the partner, but can you please tax us at entity level? That was an exception. You guys remember this point?
Yeah.
So in that scenario, no share or ownership interests are received by the taxable person who is a partner in an unincorporated partnership that is treated as a taxable person. So if these scenarios occur, but the economic reality is that it is a transaction between between a transferor and a transferee, the business restructuring relief may still apply if it is evidenced that the third party is acting on behalf of one of the two persons involved, transferor and transferee. The transferor terms in Article 27 are extended to the issue of stock to a person other than the transferor. This is what I just discussed. And an agent, basically. Let us read an example. In the heavy lifting business example, company A and company C booked the transaction at 87.5 million dirham. You remember, this is the net assets value, basically, right? Overall book value of the business. Even though the market value was 10 million and the stock issued is denominated as being 7.5 million. Company C issued the stock not to company A, but to company A's shareholders, then that issuance would not result in the transfer being a failed business reorganization. So, it can happen directly to the shareholders rather than the company. Okay, so the economic substance of the transaction stays intact. Business restructuring relief still qualifies. Applicability of Article 27, applicability provisions. So unutilized tax losses, I think we read that, where a taxable person transfers independent part of his business shall apply only to those unutilized tax losses that can be reasonably attributed. This attribution, I think I mentioned to you guys earlier on as well, that profit attribution or income attribution is a key area of corporate taxation. So reasonably attributed, the tax losses will apply only to the extent of being reasonably attributed to that independent part of the business which is being transferred. Losses incurred to a transferee simultaneously with the transfer of the independent part of the business shall be the loss reasonably attributed to that independent part of the business. 2 years rule. 2 years from the date of transfer. The provision shall not apply where within 2 years from the date of the transfer any of the following occurs. What? Shares or other ownership interests in the taxable person, that is the transferor or the transferee, are sold, transferred or otherwise disposed of in whole or in part to a person that is not a member of the qualifying group to which the relevant taxable person belongs. So if further you dispose of the shares outside the qualifying group, then this business restructuring relief shall be, what do you call that word? Clawed back. This relief will no longer be applicable and it will be clawed back. Any tax implication will come into play. There is a subsequent transfer or disposal of the business or the independent part of business transferred or other than the shares, if the same business segment is further sold off or spin off, then again before 2 years. So 2 years vesting period is there. Market value. While Article 26 Clause 6 applies, transfer of the business or the independent part of the business shall be treated as having taken place at market value at the date of the transfer. So a recapture rule applies if within 2 years of the transfer date, the shares or other ownership are sold or otherwise transferred to a person not a member of the qualifying group, or the business or independent part leaves the qualifying group, the transfer is deemed to take place at market value. So when the clawback happens, basically violation happens that within 2 years further disposal happened. So then market value will come into play. Then the original transfer will be revisited and the market value will be seen. So if you remember that 7.5 million dirham worth of transfer of business, there was a gain of 2.5 million. That gain will be taxed. If the 2-year rule is violated. Now we are coming to tax losses. There are 37, 38 and 39. I think 3 articles are there. But tax loss is a very important area of tax strategy. We have to look at it, and calculation of the future benefit is also, and it even has implications on our preparation of the financial statements as well, because tax loss, the benefit from tax loss is basically an asset, a tax asset that is reflected in our balance sheet. But we have to calculate the present value and all that. In this section, you will explore the provisions setting out the reliefs available for losses incurred in previous tax periods. Let us have a look at this article, Article 37. Tax loss is any negative taxable income calculated under the decree law for a given tax period. So basically, excess of expenditure over income. A tax loss can be offset against the taxable income of subsequent tax periods to arrive at the taxable income for those subsequent tax periods. The amount of tax loss used to reduce the taxable income for any subsequent tax period cannot exceed 75% or any other percentage specified in a decision issued by the cabinet at the suggestion of the minister of the taxable income for the tax period. Now, this 75%, is it 75% of the tax loss or 75% of the taxable income?
Taxable income.
Taxable income.
Income, correct. Taxable income for that tax period before any tax loss relief, except in circumstances that may be prescribed in a decision. So losses can be carried forward and deducted from taxable income in subsequent years, subject to a cap of 75. How many years can we carry forward tax losses under UAE
I think
Constitution?
it's still infinity.
Correct. Yes. So there is no capping of that. They can be indefinitely carried forward. The UAE restriction is more generous than the UK restriction, which is capped at 50% of the profits. So UK only allows 50% of the taxable income, to which extent tax loss can be set off. But with each standalone company or group being entitled to £5 million annual allowance. So this 5 million overrides the 50% in UK. Example, Company A has 5 million dirhams carry forward losses from 2025 into 2026. And the company in 26, Company A earns taxable profit of 3.5 million dirhams. Company A will be able to use 75% of this taxable profit out of this total 5 million tax loss that they carried forward. So leaving still a 875k tax loss will be left. Sorry, 875k of taxable profit will still be taxed, and the balance loss of 2.375 million will be carried forward. A taxable person cannot claim tax loss relief for the following 3 types of losses. Now, key point here. You remember the exemption angle? So when we have an income statement, let's say, of a client of ours, right? And we see that there are some incomes in that income statement which were actually exempt income. How would we deal with that? On a practical note, you're doing a working on an Excel. How will you deal with that income statement? Mujaddid?
Sorry, I did not get your question. Can you please repeat?
Okay, the client has provided you Excel-based financial statements, okay? So there is income statement in there, right? And it carries that singular column for the current year, let's say 2024's income appearing in that column, okay? But you see that
Okay.
within the income, a significant amount of income is exempt. For example, resident dividend or participation exemption, or like that. Some amount is clearly exempt. Okay. So and there is expenditure also that you can associate with that income, right? And even losses that you can associate with that income. How are you going to deal with that column? Are you going to split it?
Yes. Yeah. We are going to split that into exempt income and exempt expenses from the operating income.
Yeah, so basically what we will do is we will split that column into taxable and exempt, right? Taxable will be
Yeah.
taxable.
Yeah.
The exempt column will contain the exempt income and corresponding expenses as well. And at the bottom line, even if we have in if we have in the statement of changes in equity, if we have the carried forward losses, even those losses will be split, correct?
Yes.
So even the loss that we have, brought forward loss, even loss will be split into the taxable portion and exempt portion. So we will have a full column with incomes, expenses, even tax loss that relates to exempt and taxable income, and that's how we will prepare the working for the return. I hope this point is clear to everyone. Okay, so taxable person cannot claim tax loss relief for the following three types of losses. Losses incurred before the date of the commencement of corporate tax. Obviously, I mean, most of the companies have become subject to tax from the calendar year 2024 because they were following the Gregorian calendar year, right? So before this date, we will have to ignore the losses, pre-tax losses, we call it. Losses incurred before a person becomes a taxable person under the decree law. Now, for example, natural persons, there is a later date when the natural persons will be subject to corporate tax or they are required to register for corporate tax. So, whenever this is one example only, but whenever the taxable person actually whenever a person actually becomes a taxable person, before that, if there are any losses that have happened, they will not be considered as tax losses. And then there's a third thing, losses incurred from an asset or activity, the income of which is exempt or otherwise not taken into account under the decree law. So if there are, those losses which pertain to exempt income or not included in taxable income, they will also be excluded. Foreign permanent establishment, remember guys, if there are losses which pertain to foreign permanent establishment and we are using the exemption method, then we are going to exclude
Yes.
losses of foreign permanent establishment.
I have a question. It shouldn't be business loss relief.
Yeah,
Why they have called it tax loss?
business the nomenclature is tax loss relief, but actually it is business loss relief.
Yeah,
Yeah,
got it.
it is same thing. Like, it is whatever you might want to call it, it is that tax loss which is coming as a result of our profit and loss account and
Yes.
being taken forward. You might want to call it business loss relief because it is there in maybe Pakistan's tax law, but here in
Yeah,
UAE, we usually call it tax loss. It's the same thing. We can refer to it in our conversation as business loss relief as well.
yeah.
Okay.
But over here in Pakistan, it cannot be carried forward for unlimited time period. It's 6 years.
Correct. Yes. But here it is indefinite.
Unlimited, yeah, indefinite.
Okay. Of the 85 million losses, company carried forward in 2026, 81 million had been incurred in 2023. Ah, since company A has a 31 December tax period, the first tax period is 2024, and consequently, the actual deductible losses are only 4 million dirham. Why? Because out of the total 5 million, 1 million loss relates to 2023, which was a pre-tax period. So we will ignore this. A tax loss carried forward to a subsequent tax period must be set off against the taxable income of that subsequent tax period before any remainder can be carried forward to a further subsequent tax period. So let's read this carefully. A tax loss carried forward to a subsequent tax period must be set off against the taxable income of that subsequent tax period before any remainder can be carried forward to a further subsequent tax period or any tax loss transferred under Article 38 of the decree law can be utilized. What is Article 38, Haya?
Transfer of tax loss.
Okay, same thing.
Yeah.
Basically, in short, it has to be set off against taxable profit in a year before it can be carried forward. The ordering of loss relief requires losses incurred in previous years to be firstly deducted before a company can use any loss transferred to it by a related company. So, we just saw, right, in a restructuring relief, we saw that we can acquire tax losses of another business when we purchase it, right? So the whole idea is that before we can utilize those losses, first our own tax losses brought forward must be offset. Now we're talking about transfer of tax loss. So
I
uh,
have a question over here.
yes,
Yes.
Up to only 75% of taxable income, we can offset our tax loss.
Yes.
Okay, for example, we have 100,000 AED taxable income, and we 75% of this can be offset with our tax loss, and remaining 25% can we offset the transfer tax loss with the remaining 25%, or the cap is for both
No,
the 75% cap.
I think you misunderstood this point here, Haya, a little bit. Let me
Yes.
explain to you what is being what has been said. It is irrespective of this 75% is irrespective of the size of the tax loss. Let me explain to you. Let's say tax loss brought forward was uh, let's say 5 million. Okay.
Okay.
We're talking about the tax loss as 5 million. Okay. Our taxable profits or taxable income was only, let's say, 2 million. Okay. So what does that mean? It means that the maximum amount of tax loss that we can offset will be 75%, meaning this multiplied by this 75. You know, the only amount of net taxable income on which we will pay the corporate tax, net taxable income will be the difference of the two, this minus this.
Yeah, I got that. It's 5 million. Now,
But
yeah.
but but your question was, how will we deal with it, right? So what about the tax law? So answer is this much amount of tax loss that will be carried forward will be calculated like this. Do you understand
No,
my?
I was asking that what this is what I understood. I was asking if we received any tax loss from in a group.
Okay.
So the last point was the fourth point was a tax loss carried forward to a subsequent tax period must be set off against the taxable income of that subsequent tax period before any remainder can be carried forward, and any tax loss transferred under Article 38. I am talking about the transfer tax loss.
Okay.
The remaining net taxable income is 5 million, 5 lakh, right? Can we offset our transfer tax loss with this?
Okay. Oh, okay. I get. So what? Let me segregate it. This is
Yeah.
basically how do you? Okay. Uh, let's say let me call it as the internal
Yes.
tax loss. Okay. And then we have
Transfer tax loss.
transfer tax loss.
Yeah. The cap is for both accumulated tax losses.
So the point is that let's say, let me write something here actually. Okay. Now, this is the situation that we are facing. Okay. So, one more zero. Okay. So the rule is that the order is that first we will have to utilize our internal tax losses. If something is left, that we can carry forward, and this whole amount will be carried forward. Nothing will, this we will be able to carry forward until this, internal tax loss exhausts completely. We will not be able to offset this. But it's a futile discussion. Why? Because even if we continue to exhaust our internal, tax losses, this loss, we're not losing any benefit out of it. It stays until infinity. The transfer tax loss stays.
Yes, now I got the answer.
Uh,
Basically, 75% cap is on the both, like accumulated tax losses.
yeah, if you really think about it, it
Yeah.
is cumulative.
Yeah.
But
Actually, I think the cap. That's why FTA have capped the taxable income as a 75%. So at least each year they will get something as a cash flow from the company's profit.
hmm,
Like for example, if it can be like, for example, you can set 100% of the income against all your internal and transfer losses, but that's why they have kept at 75% cap on the taxable income.
Okay, I'm going to leave you with one question, all of the participants. Maybe you may have immediate answer. What if, sorry, let me ask a question here. Sorry, where the hell is that? Let me ask this question here. There was taxable, there was tax loss available with the company. They could have offset 75% of tax loss, but they decided not to offset. They said we have decided we will pay tax on it. What will happen in this scenario? Think about it. Will this tax, the 75% that was around 1.5 million, that was the allowed thing. Will this benefit be lost?
Yes, I think it will be lost because they could claim 75% of the loss, but they choose not to. So I think it will be lost. So their carry forward tax loss will be reduced by this.
Exactly. That's why Haya, do you understand what is mean?
Yes.
Losses
So
can
say,
carried forward when incurred before the income tax applicable, before the person becomes a tax person, or incurred in to conduct an activity, but carried forward, which where was this article? Losses incurred previously to be firstly deducted before a company can use any loss transferred to it by related. No, this is the one. Okay, anyways, let's read through. This section sets out the rules for allowing a tax loss incurred by one juridical person to be, okay, this is a transfer of tax loss, but I think we have to look at the carry forward of the tax loss wordings very carefully to do some research on your own as well, okay? And then let us discuss this in the next session. Now we are looking at the transfer of tax loss. This section sets out the rules for allowing a loss incurred by one juridical person to be transferred to another juridical person, which then claims a deduction for it. Tax loss or a portion thereof may be offset against the taxable income of another taxable person where all of the following 8 conditions are met. Number 1, both taxable persons are juridical persons. Both taxable persons are resident persons. Either taxable person has a direct or indirect ownership interest of at least 75%. So this 75% alludes to what? Qualifying group.
yes.
In the other, or a third person has direct or indirect interest of at least 75%. In common ownership under Article 38(1)(c) must exist from the start of the tax period in which the tax loss is incurred to the end of the tax period in which the other taxable person offsets the tax loss transferred. Common ownership, the 75% must exist from the start of the tax period until the end of the tax period. None of the persons are exempt or qualifying free zone person, then the financial year, then the accounting standards. So similar condition, if you really think about it, some of the conditions are being repeated in 3 scenarios. Transfer of qualifying transfers of assets. Then what was the second one? Restructuring relief. And now transfer of tax loss amongst between qualifying group members. Both the transferor and the transferee must be UAE. Okay, this is a repetition. So I'm going to go to the next stage. Transferring of tax losses. UAE provision is modeled on the UK provisions, which requires that both claimant and surrendering companies be resident or if non-resident, but within the charge to corporate tax and be members of the same group. Means that one company must be 75% subsidiary of the other, or both must be 75% subsidiaries of a third company. Definition of 75% subsidiary requires one company to have direct or indirect Beneficial ownership. You know, the one thing that I find very intriguing in the UAE corporate tax law is the lack of the use of the word beneficial ownership or UBO and all that. Only few places you will find beneficial recipient word written. So UBO has been, I think it has been ignored or less utilized. Probably this is an area where a lot of action will happen in UAE, probably in the corporate tax realm. Beneficial ownership of at least 75% in the ordinary share capital in another. Let us go through the draft quickly because we've already finished it. This is a recap kind of a thing. Taxable person which the tax loss is transferred to shall reduce the taxable income for the relevant tax period. The total tax loss offset shall not exceed the amount allowed under 37(2), which is 75% of the taxable income, and taxable person shall reduce the available tax losses by the amount of the tax loss transferred to the other taxable person for the relevant tax period. Now, please remember something. We are talking about two separate TRNs. These are two separate taxpayers, guys. This is not tax group. This is two separate TRNs. So one company is transferring tax loss to the other company. Okay. So the one who's transferring will reduce the amount of loss so transferred from its tax losses, and the other company will offset that loss. The transfer reduces the tax loss uh, up to the extent of 75% of the taxable income of the person to whom they transferred the tax loss, and this is how it moves on.
So just one small thing. The loss transferred, i- is that also limited to 75% of the transfer or the transferee's income, or I mean that can be
Yes, actually,
more than that.
if you really think about it, actually it is mentioned here. The taxpayer shall reduce the transferee reduces the transferred loss from its taxable income for the tax period, and the loss adjusted cannot exceed 75% of the transferee's taxable income. Uh, Let me read. Yeah, the total tax loss offset shall not exceed the amount allowed. Let me read in the first place as well. Taxable person which the tax loss is transferred to shall reduce his. So apparently, it is not written here. This is which article? This is article number 38, correct?
38. Yeah.
Go to the source and see your point, which is a very good point actually. Because until now I haven't read this thing, because otherwise if it is not clearly mentioned, then if, tax laws beyond the 75% taxable income of the transferee may be allowed, right, Abbas? So we are basically
The
looking
transfer.
at this particular point. So let us have a look at it. A tax loss or a portion thereof may be offset against the taxable income of another taxable person where the conditions are met. Both are juridical person, resident person, 75% ownership. Common ownership must be vesting period of the entire tax period. None of the person is an exempt person, qualifying free zone person, same financial year, same standard. Now, I think beyond this, we will find the answer. Where a taxable person transfers the tax loss to another taxable person, uh, uh, under clause 38(1) of this article, the taxable person which the tax loss is transferred to shall reduce his taxable income for the relevant tax period. The total tax loss offset shall not exceed the amount allowed under Article 37(2) of the decree law. Until now, we haven't read it. It says the tax loss offset, doesn't say transferred. But let's read C. Taxable person shall reduce its available tax losses by the amount of the tax loss transferred to other taxable persons for the relevant tax period. So, Abbas, apparently,
There's
your
no limit.
question is unanswered in Article 38.
Mhm.
Apparently,
Yeah.
this is an unanswered question, and if there were a decision, I would have included it here. Apparently, there's no ministerial decision or authority decision, because this is not a matter for cabinet. But anyways, this I will have a look at it whether there is still any guidance provided by either Federal Tax Authority or through any ministerial decision. Apparently, up till now, it is not appearing. We can look at it.
Okay, thank you.
Limitation on tax laws carried forward. Let us have a look at it. Maybe, yeah, I think this is Article 39. Okay. Tax losses can be carried forward and utilized in accordance with the provisions of Clause 37 from the beginning of the tax period in which the tax loss is incurred to the end of the period in which tax loss or part thereof is offset against taxable income of that period. The same person continuously owned the 75%. These are still those conditions. The taxable person continue the same or similar business activity. Relevant factors in determining whether a taxable person has continued to conduct the same or similar activity following a change in direct or indirect ownership include. So these are only the conditions, relevant factors being mentioned here. Taxable person uses same or all of the assets before the change happens. Taxable person has not made significant changes to the core identity or operation of the business. Or a third one, where that have changed the result from the development or exploration of assets, services uh, uh, that existed before the ownership change. None of this is still answering your question, Abbas. Clause 39
Yep.
not apply to the taxable person whose shares are listed on a recognized stock exchange. So, the listed entities are subject to heavy regulation, so they can easily transfer tax laws. All of this will not be applicable. So what we just read was limitation on tax loss transfer under, I think, Article 39 itself as well. Continuity of ownership, we said, to be deductible, tax person must have the same person or persons continuing ownership of at least 50% during the tax year. The claim year and in which the intervening year or the taxable person continue to conduct the same or similar business activity. I think they will discuss this now. The continuity of ownership test is based on the Australian continuity of ownership test, which requires the company's shares carrying more than 50% of all voting dividend and capital gains to be beneficially owned by the same persons at all times during the ownership test period. So basically, at least 50% shareholders should not change. This is the period from the start of the loss year to the end of the income year in which the loss is to be deducted. In the absence of further guidance from the Ministry of Finance or the FTA, that's why I said exactly same thing is written here as well. That's what I said. This is not a matter for cabinet. This is a matter for ministry, which is the finance minister or the authority. Cabinet decides on higher level stuff. Example, in 2024, 25, 26, Company A, which conducts a chain of hamburger fast food restaurants, incurs respectively 1 million, 1.5 million, and 2 million losses. And in 2027, Company B, which owns 40% of the Company A stock, sells the stock to Company D. Assume in 2027, Company A derives 1.5 million dirhams taxable profits. In these circumstances, the losses would be deductible losses. Were, however, Company D to also purchase additional 25% of the stock from Company F, which owns the remaining 60% of the stock of the Company A. So this was Company A basically. Uh, now this company was acquired by this Company B was already owning 40% of the stock of Company A, but in um, there's another 25% of the stock from Company F, which owns 60% stock of Company A. So it is an indirect ownership into Company A. So previous shareholding was only 40%. Now there is another indirect ownership. In those circumstances, there would not be continuity with at least 50% of the stock. and the losses could not be deducted unless the same or similar business test was to be satisfied. So there is a major change in capital structure of the company basically. So if that happens, ordinarily the this loss transfer will not be allowed until it can be proven that the same or similar business activity was being considered or was being carried out. Now we are going to look at the same or similar business test. For the purpose of Article 39, relevant factors for determining whether a taxable person has continued to conduct the same or similar business activity following a change in the direct or indirect ownership includes assets, core identity, or operations and changes. Let us have a look at this. The taxable person uses some or all of the same assets as before the ownership changes. So assets portfolio hasn't changed. Core identity. The taxable person has not made significant changes to the core identity or operations of its business since the ownership change. Let's look at the changes as well. Where there have been any changes, these result from the development or exploitation of assets, service, processes, products, or methods that existed before the ownership change. So if these tests are met, then the the loss transfer will still hold good. The company will still be able to offset transferred or acquired losses. To satisfy the same business test, the taxable person must have same or all of the assets previously used, no significant changes in the core identity or operation after the ownership change. And even if there were changes made, they were from basically exploitation or exploring of services, processes, etc. So it was invention. The same or similar business test has been modeled on the Australian same or similar business test. Australian, it is satisfied if a company carries on the same business. I think we've read enough. Okay. Similar business test supplements the same business test. For a company to pass the similar business test, a company can carry forward and utilize its prior year losses if it carries on a business that is similar to the business it carried on before the continuity of ownership test is failed. The Australian law establishes that a business is to be similar to the former business when there is an element of continuity of the business identity or operation. For this purpose, each of the following must be considered: assets, activities and operations, identity, degree of connection and continuity. And these include what? Extent to which the assets, including goodwill that are used in the current business to generate assessable income, were also in the company's former business. So, same assets, even goodwill was there to run the operations. The extent to which the activities and operations from which the company's current business generated assessable income throughout the business continuity test period were also the same activities and operations during the period of the assessable income. A comparison between the identity of the former business and the current business. So basically, it's a reality test. Basically, it's a test of facts. Conditions of the degree of connection and continuity between the former business and the current business to the extent to which any changes to its former business results from the development or commercialization of assets, products, processes. So basically, in short, uh, either same business or similar business tests will be performed which take into account the identity, operations, assets, etc. If substantially the economic realities have not changed, then same or similar business criteria would be seen as met, and the transfer of loss and offset by the acquirer will be allowed. Okay. Assume that in the above example where company A conducts a chain of hamburger fast food restaurant, then competition from Mickey D hamburgers has become so fierce that company A's new stockholders decide to close 10% of the stores and convert its debt to equity ratio from 3:1 to 1.5 to 1, and also decide to outsource the bread bun manufacture previously carried out in-house. The remainder of the outlets continue, the pricing remains the same, and the company colors and brand name remains unchanged. Taken into account these changes, it is likely that the same business test would be met. There were changes, but they were not significant enough to raise the issue whether at all this same business or similar business was being continued. So it was similar. Article 39 shall not apply to a taxable person whose shares are listed on a recognized stock exchange. Why? Because the recognized stock exchange is highly regulated. So no tax implication would arise. What is the recognized stock exchange? Any stock exchange established in UAE that is licensed. So we have two first tier capital markets and another alternative investment market, which is NASDAQ. But main ones are DFM, Dubai Financial Market, and ADX, which is Abu Dhabi Stock Exchange. Neither the continuity of ownership nor same business test need to be satisfied if the taxable person is listed on a recognized stock exchange. That's an easy one. Withholding tax. What is the withholding tax rate here in UAE? 0%. In this
0%.
you will review the UAE taxes that need to be deducted from the UAE. Were a non-resident person to receive payments made from UAE, you will start examining withholding tax Article 45. So it is 0%. The categories of UAE sourced income derived by non-resident persons as described in the decision issued by Cabinet under Article 45, insofar such income is not attributable to a permanent establishment of the non-resident person in the state. No decision has been issued. So until now, there's nothing on withholding tax. It's 0%. Withholding tax credit. This is we have discussed quite a lot of times, but some interesting points are going to come here. So we will quickly do a recap. I think this you guys already know. But if a person becomes a taxable person in a tax period, person's corporate tax due under Article 3 can be reduced by the amount of withholding tax credit. What is that credit? Withholding tax credit is the amount of tax withheld that can be deducted from the corporate tax due in accordance with the decree. But here we don't have withholding tax credit. What we have is foreign tax credit. We'll see that. Maximum withholding tax credit is the lower of the amount of withholding tax deducted under the Article 45 or and the corporate tax due under the decree law. So I think this rule is prevalent all over the world. Excess withholding tax credit. Any excess credit for a taxpayer as a result shall be refunded to the taxable person in accordance with the Article 49. Where a non-resident person were a non-resident person to become liable to both UAE withholding tax and corporate tax, then any excess withholding tax is to be refunded. Foreign tax credit. That's something we should remember. So corporate tax due under Article 3 can be reduced by the amount of foreign tax credit. I think we all know that. Foreign tax credit under the decree law cannot exceed the amount of corporate tax due to relevant income. Now, I remember reading a double tax agreement between UAE and Singapore. If you guys have access to it, you read it, you will find something funny and very interesting in there. That double tax agreement allows deduction of tax in Singapore for the UAE entities. And to my interpretation, because double tax agreement trumps the domestic corporate tax law, this is a funny situation because the Singapore has a higher tax rate than UAE. So it is going to be a very big issue when FTA will face, because if there is a tax scenario, a UAE subsidiary, a UAE company which is doing business in Singapore, if they're subject to a higher tax deduction in Singapore, they may be entitled to claim it under the double tax agreement. But that we will leave for now. We will look at the remainder provision. Foreign tax credit under the decree law cannot exceed the amount of corporate tax due on the relevant income. Remember, this is the provision of the domestic law of UAE. And the double tax agreement is under international law, Vienna Convention. And wherever double tax agreement conflicts with the domestic law, the double tax treaty prevails over the domestic law. Any unutilized foreign tax credit as a result of Article 47 cannot be carried forward or carried back. This is a key point, guys. This is a, how do you say, a caveat? Because if you have unutilized foreign tax credit, can it be, carried forward? No, that's a very bad thing, actually. So we have to be very careful about this matter. Taxable person shall maintain all necessary records for the purposes of claiming foreign tax credit. The credit available, this is a repetition. Now I think this may be the last topic for today. Tax group formation and cessation. So I'm going to be quick. There's Article 40 for tax group, and a decision also has been there, 125, ministerial decision number 125. We will directly look at the provisions. I think some of you may remember that there has to be a parent company that has to be identified, and a subsidiary that has to be identified. In a tax group, all members must be resident persons. There has to be a 95% shareholdership in subsidiary, direct or indirect, through one or more subsidiary. What does that mean, direct, indirect?
Cumulated be directly and indirectly should be 95%.
Yeah, or
Holding of the holding, sub-holding.
Sub-holding, exactly. Both things are possible. But the point is that aggregate 95% holding should be there, and there should be a parent company. Parent company itself being wholly or partly owned by a non-resident person does not exclude the parent company, and it's at least 95% owned subsidiaries from forming a tax group. Parent company holds 95% of the voting right. So these are alternative criteria. You can have shareholding, you can have 95% voting rights also, or even there is possibility of 95% profits, net assets, liquidation proceeds, etc. Now, then common clauses. None of the members of a tax group can be an exempt person or qualifying free zone person. Why? Because tax group itself is basically offsetting the tax losses. So, if we bring in exempt persons already, which are already not subject to corporate, that will be a very bad thing from the government's treasury perspective. We are, will be offsetting taxable profits against exempt losses. That will be bad. Parent company and subsidiary have the same financial year, same accounting standards. So if these conditions are met, then we can form a tax group basically. So what else is there? There's some mention of Australian tax law. Let's quickly go through. Tax group rules have been modeled on the tax group rules incorporated in Australian law. Less restrictive in that the UAE rules permit consolidation with 95% common shareholdership, whereas the Australian rules require 100% common ownership. They are more restrictive than the Australian rules, which admit to a tax group membership a partnership or trust. But when the Article 42 wording does not refer to a partnership or trust. Students should be aware that whether the decree law treating of the partners in a general partnership and beneficiaries is in an elected trust or foundation to be the taxable persons would enable them to apply for tax group. So just to let you know, in a guide, general partnership has been accepted as a juridical person, acknowledged as a juridical person. So please remember this point. And I just came, I think one day ago or something, I saw a law which was issued, I think, in 2023. That law was on trust, and I read that the trusts that are formed in mainland will have a separate juridical personality. So, and foundations by default have juridical personalities. These points we should remember, that if it is a juridical person, it can become part of the tax group. Company A and its 5 wholly owned subsidiaries are all UAE juridical persons, with Company C, one of the 5, being a qualifying free zone person. Company A and 4 subsidiaries, excluding Company C, why? Because it's a qualifying free zone person, can apply for tax group. So, Mujaddid, have you formed a tax group for any clients yet, or Abbas?
No,
I
not
haven't
yet.
come across any.
Okay, okay.
I haven't come.
You guys are dealing with UAE corporate tax clients? Okay. Since the parent and 4 subsidiaries are UAE tax resident juridical persons, 95% commonly owned, not exempt and not qualifying free zone persons, with each having continuous year ends, with each adopt IFRS, FTA should approve the tax group application, but naturally qualifying free zone person will not be included in there. Exempt person also cannot form. It raises some questions here, by the way. What does a tax group do? It becomes one taxable person, right? So it has to form, it has to file a tax return. Tomorrow, if FTA says that please provide us the financial statements of the tax group, what will be the implication of it? The original corporate group, irrespective of tax, had a qualifying free zone person in it as well, or an exempt person in it. Then how will the financial statements be provided to the FTA?
You'll have to carve out the QZFP from the main group's accounts.
Special purpose financial
Two
statement,
consolidated statements will be prepared.
consolidated statements. Yeah, but
Yeah,
will that be in line with IFRS? Because you will need to exclude one subsidiary, which was a qualifying free zone person.
2 sets of consolidated statements will be prepared, na? One
But
for the tax purposes and one for the IFRS.
correct. Yeah, but the only point that I'm trying to raise here, Haya, is
Yeah.
that the other consolidated financial statements that are for tax purposes will
Yeah.
not be IFRS compliant to the extent of removing that subsidiary.
Yes.
So we need to remember this, that it will be a
Mm.
special purpose financial statement.
Yes.
Becoming members of a tax group. Okay, let's go through this. Notwithstanding paragraph 40, one or more subsidiaries in which a government entity directly or indirectly owns at least 95% ownership interest uh, can form a tax group subject to the conditions prescribed by FTA. There was a decision on government entities for forming a tax group. So when are government entities subject to tax? Can you recall? That was a very early stage thing that we read, right? Article 5, I think. When is a government entity subject to tax? Government entities are exempt, ideally. Am I right?
Yes.
So when is a government entity taxable?
Commercial activities they are involved in.
Can somebody else also answer that? Now, there was a specific thing provided there in the law.
If they, for example, have an holding in any non-government entity, or for example, there is
No, article said that if a government entity engages into commercial entity under a trade license from a supervising authority, from a registration authority, that is the case when the government entity will be subject to tax. So, and when we talk about forming a group, tax group, we are referring to that operation, commercial operation under a trade license from a supervising body. The company may still be consolidated even if not less than 95% of its capital is controlled by a government entity. So there's application will be made. Single taxable person. Tax group formed is treated as a single taxable person for the purpose of the decree law. And there is a matter of representation. So the parent company represents the tax group. There is always one person who has to be established as the responsible person or representative person. The parent company shall comply with the obligations set out in chapter 14, 16, and 17. Let's see what this is. Payment and refund of corporate tax. Okay. Tax registration, deregistration, and tax returns and clarification. So that's the job of the responsible person. So basically, one company will be positioned, which will be a parent company. Operating as a consolidated group requires the parent company to, among other things, take the following actions. Make a choice to form a consolidated group with effect from a certain date. Make a choice to form a consolidated group with effect from certain date. Notify FTA, calculate a report and pay the taxes, file returns, etc., etc. All the actions will be the responsibility of the parent company. Now, what else? Let's have a quick look at the subsidiary also. Subsidiary can join an existing tax group following the submission of an application to FTA by the parent company and the relevant subsidiary. Subsidiary shall leave the tax group following approval by the FTA of an application by the parent company and the relevant subsidiary. At the date of writing, no such conditions have been identified. Where the subsidiary becomes an exempt person, for example, or a qualifying free zone person, by default it will have to move out. So as an action of law, it will have to go out. A newly acquired and newly established qualifying subsidiary can join a group. An existing group member can leave with FTA approval or follow a change in the shareholding relationship, which results in cessation of the 95% rule. Changes to a tax group. Let us quickly read through that as well. Ceasing a tax group. A tax group shall cease to exist in any of the following circumstances following the approval of the Federal Tax Authority on an application by the parent company. At the date of writing, no such conditions have been published by the FTA. Were the parent company no longer meet the conditions to form a tax group as specified in the Article 40. So whenever conditions are being non-compliant, tax group will need to be dissolved. Following the FTA approval, a group can be terminated, or following along with the parent company no longer meets the conditions, the group shall cease to exist. A grouping application not stated as being irrevocable in the decree law, but it effectively is irrevocable under one of the specified circumstances exists. Yeah, so when they say circumstances, that means the various conditions that they mentioned. Quite a few conditions were mentioned. Same accounting year, IFRS, this, that. If those conditions are not met, there will by default be a change to the tax group status. Application to be replaced by another parent company. The parent company of tax group can make an application to the FTA to be replaced by another parent company. Naturally, there's a change in the group structure without a discontinuation of the tax group. If the following conditions are met. Naturally, some continuity criteria are there. New parent company meets the conditions. It is still a resident company. It is not an exempt company. It is not a qualifying free zone person. Former parent company ceases to exist, and the new parent company or subsidiary is its universal legal successor. So if that is the case, then a new parent can replace the old parent. Following an FTA approval, application by the parent. So dissolving a tax group. Okay, FTA can at its discretion dissolve a tax group or change the parent company of a tax group based on information available. So this is a unanimous action taken by the FTA and notify the parent company of the decision. FTA retains a power to unilaterally terminate a tax group or change a parent relying on the information available to the FTA. Tax group is not given a right to object to such a decision by the FTA unless the objections procedures with the federal decree on procedures. There's a law number 28 of 2002 called the Tax Procedures Law. If that is there, if only under this law you can, raise a grievance with FTA. Without those procedures currently containing any right to object except in the circumstances of assessments and penalties. It seems unlikely that a group could object to FTA's unilateral action under the Article 14. That's an easier one. Date of formation, date of cessation. Let's have a quick look at it. Forming for the purpose of Article 40, tax group shall be formed or a new subsidiary shall join an existing tax group from the beginning of the tax period specified in the application or from the beginning of any other tax period determined by the FTA. Tax group exists for the entire tax period specified in the application or for another tax period determined by the FTA. So in short, entire year, for the entire year, the tax group is applicable. Tax group is not given a right to object to such decision by FTA unless the objections are processed under the decree law, under the tax procedures law. Same thing, leaving of the tax group. For the relevant member of a tax group shall be treated as leaving that tax group from the beginning of the tax period. Similar, same rules apply. Member leave the tax group for the entire tax period specified in the application or it can happen from a subsequent tax period as well. And there is no right granted for objection, etc. There's another point raised here. A subsidiary no longer qualifying or a parent no longer qualifying, the relevant members of the tax group shall be treated as leaving that tax group from the beginning of the tax period in which the conditions are met. So whatever we've discussed, the key common fact is that the changes in tax group take effect from the beginning of the tax year. Again, it is not a very complex thing, taxable income of a tax group. Let us see if there's okay. So there is a decision, ministerial decision 125 of 2023 as well, which identifies how the taxable income is calculated. So consolidated financial statement shall be prepared covering each subsidiary that is a member of the tax group. Transaction between the parent company in group company shall be eliminated, intra-group transactions. So for the purpose of determining the taxable income of a tax group, the parent company consolidated. Okay, this we read. The assets, liabilities, income, expenses of the group form are consolidated, which means the transactions between the members are eliminated. What else is there? Relevant, okay, shall apply. Okay. Tax losses. Okay, this we've discussed, but anyways, unutilized tax losses of a subsidiary. This is important. Unutilized tax losses of a subsidiary that joins the tax group shall become carried forward tax losses of the tax group. It can be used to offset taxable income of the tax group insofar as the income is attributable to the relevant, insofar as the income is attributable to the relevant subsidiary. So, that's a very important point. New company is joining the tax group. Can the losses of that new company offset the incomes of other companies in the tax group? No. It can do so to the extent of its own income, new subsidiary. Where a new subsidiary joins an existing tax group, unutilized tax losses of the existing tax group cannot be used to offset the taxable income of the tax group insofar as the income is attributable to the new subsidiary. So that's a very important point. For the new subsidiary, they cannot be, income cannot be offset against the previous members, or the losses of previous members cannot be offset against the income of the new subsidiary. Application of clause 3 and 4 of the article is subject to the conditions of other article 37 to 39, which was, I think, transfer of tax losses. Okay, what else is there? I think this we have read. This when a subsidiary leaves the tax group, what happens? When subsidiary leaves the tax group, tax losses of the group shall remain with the tax group, with the exception of any unutilized pre-grouping losses of the subsidiary. So subsidiary can take back only those losses which were there before it joined the group. Otherwise, it will surrender its losses to the tax group. Where a company ceases being a tax group member, the losses incurred by the member remain with the group. Now, what about cessation of the tax group? On cessation of a tax group, this is a very important point. Unutilized tax losses of the tax group shall be allocated as follows. Where the parent company continues to be a taxable person, all tax losses shall remain with the parent company. Key point. Where the parent company ceases to be a taxable person, tax losses of the tax group shall not be available for offset against future taxable income of individual subsidiaries apart from any unutilized pre-grouping losses of such subsidiaries. So, this is a very key strategy point for tax group. If any tax group is deciding to cease to exist, these are the two provisions that are going to play. Non-applicability, continuation of the tax group. This article of the tax group shall not apply where there is a continuation of the tax group under Article 40. The rule preventing subsidiaries using tax losses should a tax group cease to exist overridden were the individual subsidiaries to become members of a new tax group. So, the we'll have to, I think, read through the Article 42. Yeah. So it's a big article, basically unutilized losses of subsidies that joins. This we all read. We see which rule we were looking at. Article 42 7b shall not apply. Okay, what is Article 42 7b? Where the parent company ceases to be a taxable person, tax losses of the group shall not be available for offset against future taxable income of the individual subsidiaries, with the exception of unutilized pre-grouping losses. Tax subsidiaries can take back their original pre-grouping losses. Otherwise, the whole losses of the tax group will expire. Uh, shall not apply where there is a continuation of the tax group. Yeah. So this is a big loss if you remember. Like parent company was no longer a taxable person. Uh, Tax losses would not even be available to subsidiaries. But this will not apply if the tax group continues. And continuing of tax group is advised under Article 40. And how we remember this, that how can a tax group continue? A parent can change. So new parent can come and take over. Where assets or liability is transferred, Article 42 shall not apply where an asset or liability has been transferred between members of the tax group and either the transfer or transferee leaves the tax group within 2 years. Again, same thing. Basically, wherever this 2-year duration comes in, it is a clawback period. So, one asset was transferred from one company of a tax group to another company, and naturally, though no gain loss was booked, if it leaves the tax group before 2 years, then clawback will become active. Income not considered. Any income that was not considered with regards to a transfer shall be taken into account. Again, it will be, I think, shall be taken into account on the date the transfer or transferee leaves the tax group and shall result in a corresponding adjustment in the cost base of the so if we did not take into account, like for example, intergroup transaction, so there was an intragroup transaction that was eliminated because of tax group, but a subsidiary leaves the tax group. The day it leaves the tax group, that elimination will be clawed back, and tax will be applied to it. Corporate tax will be applied to it. Let us start off with the knowledge check. A participation interest means a dash percentage or greater ownership.
5%.
5%. Okay. Next one. Which of the following are conditions that must be met in order for a foreign permanent establishment to be exempt from taxation under Article 24 of the tax treaty? We have to tick. The income must be attributable to the foreign permanent establishment. I think we discussed it. Attribution, remember? Attribution of income to permanent establishment. FAR analysis. Income must be derived from sources within the host country. Why? Like, let's say we have a branch in Oman, and that Oman branch is attracting business from USA. Will, this restriction, do you think is valid?
No.
The foreign permanent establishment must be engaged in a trade or business activity in the host country. Yeah, I think this seems fair. The foreign permanent establishment must be subject to tax in its home country. Yeah, I think yes.
Yes, it was there.
Taxpayer must meet certain ownership requirements with respect to foreign permanent establishment. I'm not sure if this was there. So this was not there. This was not there. Let's submit this. Yep. Let us see if the income derived by a non-resident person from the operation of aircraft or ships in international transportation shall not be subject to corporate tax, which of the following conditions are met? Let's see. Non-resident person is in the business of international transport of passengers, livestock. Yes, I think it was there.
Yes.
Leasing or chartering of aircraft in
Yes.
international. Leasing of equipment integral. Yes, it was also
Yes.
worthiness and airworthiness. Correct. Let's go to the next one. No dash needs to be taken into account in determining the taxable income in relation to transfer of one or more assets or liabilities between two taxable persons that are members.
Gain and loss.
Gain and loss. Yes. Okay, let's look at the fifth one. Business restructuring involves transfer of independent part of business from a transferor to a taxable or soon to be taxable person. This is definitely right, right?
Yes. Yes.
Transfer of equity from a transferor to a taxable to be, that is not there. Transfer of profit. No, this will also equity profit, same thing. Transfer of the entire business from a transferor to a taxable. Yeah, this I think will apply, right? Independent part of the
Yes.
business or entire business. These are right. Yep, correct. What else? The amount of tax laws used to reduce the taxable income.
75%.
75%. Okay. Max, yeah, 75% tax loss. Yes. 75% of the taxable income. Yes. Select all that shall apply. A taxable person cannot claim tax loss relief for losses incurred from a business activity that is not registered with the government. Now that is not correct. Losses incurred before the date of commencement of corporate tax.
Yes.
Tax loss. Losses incurred before a person becomes a taxable person.
Yes.
Losses incurred from an asset or activity, the income of which is exempt. I think yes.
Yeah.
You remember? We discussed about this.
Yeah.
What else? Capital gains. Why? Capital gains is part of the profit and loss account.
Profit and loss account.
It is a default unless it is participatory participation capital gains a lot, but this is not written like that. So I'm going to exclude it. Correct. Acha, what next is there? To satisfy the same business test, taxable person must use some or all of the dash previously used and not have made any significant changes to the core identity or operation of the business after ownership change. Some assets, I think.
Assets previously used.
Okay. Correct. What else is there? 9. Select the correct answer to complete the following state. Withholding tax rate, yeah, I think
0%.
that's an easy one. Then we have, yeah, correct. Next, last one, true or false. To be considered a tax group, both the parents and subsidiary company must be UAE resident, juridical person, sharing common at least 80% ownership.
False 75%.
False.
75%. Are you sure?
95%.
95%.
95%.
95%. So false. And bingo. That's it. Okay, guys, it's already very, very late. Thank you very much. Just 1 minute before 2 o'clock, we will sign off. Okay. Thank you.
Thank you.
Thank you very much.
Thank you. Take care. Bye bye.